Book 5, Chapter 1 of Principles of Political Economy. This is a LibriVox recording. All LibriVox recordings are in the public domain. For more information or to volunteer, please visit LibriVox.org. Recording by Anna Simon. Principles of Political Economy by John Stuart Mill. Abridged by J. Laurence LAUGHLIN. On the General Principles of Taxation. Section 1. 4 Fundamental Rules of Taxation. One of the most disputed questions, both in political science and in practical statesmanship, at this particular period, relates to the proper limits of the functions and agency of governments. We shall first consider the economical effects arising from the manner in which governments perform their necessary and acknowledged functions. We shall then pass to certain governmental interferences of what I have termed the optional kind, that is, overstepping the boundaries of the universally acknowledged functions, which have heretofore taken place, and in some cases still take place, under the influence of false general theories. The first of these divisions is of an extremely miscellaneous character. Since the necessary functions of government, and those which are so manifestly expedient that they have never, or very rarely, been objected to, are too various to be brought under any very simple classification, we commence, under the first head, with the theory of taxation. The qualities desirable, economically speaking, in a system of taxation have been embodied by Adam Smith in 4 maxims or principles, which, having been generally concurred in by subsequent writers, may be said to have become classical, and this chapter cannot be better commenced than by quoting them. 1. The subjects of every state ought to contribute to the support of the government as nearly as possible in proportion to their respective abilities, that is, in proportion to the revenue which they respectively enjoy under the protection of the state. In the observation or neglect of this maxim consists what is called the equality or inequality of taxation. 2. The tax which each individual is bound to pay ought to be certain and not arbitrary. The time of payment, the manner of payment, the quantity to be paid, ought all to be clear and plain to the contributor and to every other person. The certainty of what each individual ought to pay is, in taxation, a matter of so great importance that a very considerable degree of inequality, it appears, I believe, from the experience of all nations, is not near so great an evil as a very small degree of uncertainty. 3. Every tax ought to be levied at the time or in the manner in which it is most likely to be convenient for the contributor to pay it. Taxes upon such consumable goods as are articles of luxury are all finally paid by the consumer, and generally in a manner that is very convenient to him. He pays them little by little as he has occasion to buy the goods. As he is at liberty, too, either to buy or not to buy as he pleases, it must be his own fault if he ever suffers any considerable inconvenience from such taxes. 4. Every tax ought to be so contrived as both to take out and to keep out of the pockets of the people as little as possible over and above what it brings into the public treasury of the state. A tax may either take out or keep out of the pockets of the people a great deal more than it brings into the public treasury in the 4 following ways. First, the levying of it may require a great number of officers, whose salaries may eat up the greater part of the produce of the tax, and whose perquisites may impose another additional tax upon the people. Secondly, it may divert a portion of the labor and capital of the community from a more to a less productive employment. Thirdly, by the forfeitures and other penalties which those unfortunate individuals incur who attempt unsuccessfully to evade the tax, it may frequently ruin them, and thereby put an end to the benefit which the community might have derived from the employment of their capitals. An injudicious tax offers a great temptation to smuggling. Fourthly, by subjecting the people to the frequent visits and the odious examination of the tax gatherers, it may expose them to much unnecessary trouble, vexation, and oppression. To which may be added that the restrictive regulations to which trades and manufactures are often subjected to prevent evasion of a tax are not only in themselves troublesome and expensive, but often oppose insuperable obstacles to making improvements in the processes. Section 2. Grounds of the principle of equality of taxation. The first of the 4 points, equality of taxation, requires to be more fully examined, being a thing often imperfectly understood, and on which many false notions have become to a certain degree accredited, through the absence of any definite principles of judgment in the popular mind. For what reason ought equality to be the rule in matters of taxation? For the reason that it ought to be so in all affairs of government. A government ought to make no distinction of persons or classes in the strength of their claims on it. If any one bears less than his fair share of the burden, some other person must suffer more than his share. Equality of taxation, therefore, as a maxim of politics, means equality of sacrifice. It means apportioning the contribution of each person towards the expenses of government, so that he shall feel neither more nor less inconvenience from his share of the payment than every other person experiences from his. There are persons, however, who regard the taxes paid by each member of the community as an equivalent for value received in the shape of service to himself, and they prefer to rest the justice of making each contribute in proportion to his means upon the ground that he who has twice as much property to be protected receives on an accurate calculation twice as much protection, and ought, on the principles of bargain and sale, to pay twice as much for it. Since, however, the assumption that government exists solely for the protection of property is not one to be deliberately adhered to, some consistent adherents of the quid pro quo principle go on to observe that protection being required for persons as well as property, and everybody's person receiving the same amount of protection, a poll tax of a fixed sum per head is a proper equivalent for this part of the benefits of government, while the remaining part, protection to property, should be paid for in proportion to property. But, in the first place, it is not admissible that the protection of persons and that of property are the sole purposes of government. In the second place, the practice of setting definite values on things essentially indefinite, and making them a ground of practical conclusions, is peculiarly fertile in the false views of social questions. It cannot be admitted that to be protected in the ownership of 10 times as much property is to be 10 times as much protected. If we wanted to estimate the degrees of benefit which different persons derive from the protection of government, we should have to consider who would suffer most if that protection were withdrawn. To which question, if any answer could be made, it must be that those would suffer most who were weakest in mind or body, either by nature or by position. Section 3. Should the same percentage be levied on all amounts of income? Setting out, then, from the maxim that equal sacrifices ought to be demanded from all, we have next to inquire whether this is in fact done by making each contribute the same percentage on his pecuniary means. Many persons maintain the negative, saying that a 10th part taken from a small income is a heavier burden than the same fraction deducted from one much larger, and on this is grounded the very popular scheme of what is called a graduated property tax, that is, an income tax in which the percentage rises with the amount of the income. On the best consideration I am able to give to this question, it appears to me that the portion of truth which the doctrine contains arises principally from the difference between a tax which can be saved from luxuries and one which trenches, in ever so small a degree, upon the necessaries of life. To take 1,000 a year from the possessor of 10,000 would not deprive him of anything really conducive either to the support or to the comfort of existence. And if such would be the effect of taking £5 from one whose income is 50, the sacrifice required from the last is not only greater than, but entirely incommensurable with, that imposed upon the first. The mode of adjusting these inequalities of pressure which seems to be the most equitable is that recommended by Bentham, of leaving a certain minimum of income sufficient to provide the necessaries of life, untaxed. Suppose $250 a year to be sufficient to provide the number of persons ordinarily supported from a single income with the requisites of life and health, and with protection against habitual bodily suffering, but not with any indulgence. This then should be made the minimum, and incomes exceeding it should pay taxes not upon their whole amount, but upon the surplus. If the tax be 10%, an income of $300 should be considered as a net income of $50 and charged with $5 a year, while an income of $5,000 should be charged as one of $4,750. An income not exceeding $250 should not be taxed at all, either directly or by taxes on necessaries, for, as by supposition this is the smallest income which labor ought to be able to command, the government ought not to be a party to making it smaller. Both in England and on the Continent a graduated property tax, l'impôt progressif, has been advocated, on the avowed ground that the state should use the instrument of taxation as a means of mitigating the inequalities of wealth. I am as desirous as anyone that means should be taken to diminish those inequalities, but not so as to relieve the prodigal at the expense of the prudent. To tax the larger incomes at a higher percentage than the smaller is to lay a tax on industry and economy, to impose a penalty on people for having worked harder and saved more than their neighbors. It is not the fortunes which are earned, but those which are unearned, that it is for the public good to place under limitation. With respect to the large fortunes acquired by gift or inheritance, the power of bequeathing is one of those privileges of property which are fit subjects for regulation on grounds of general expediency, and I have already suggested, as the most eligible mode of restraining the accumulation of large fortunes in the hands of those who have not earned them by exertion, a limitation of the amount which any one person should be permitted to acquire by gift, bequest, or inheritance. I conceive that inheritances and legacies exceeding a certain amount are highly proper subjects for taxation, and that the revenue from them should be as great as it can be made without giving rise to evasions, by donation inter vivos, or concealment of property, such as it would be impossible adequately to check. The principle of graduation, as it is called, that is, of levying a larger percentage on a larger sum, though its application to general taxation would be in my opinion objectionable, seems to me both just and expedient as applied to legacy and inheritance duties. The objection to a graduated property tax applies in an aggravated degree to the proposition of an exclusive tax on what is called realized property, that is, property not forming a part of any capital engaged in business, or rather in business under the superintendence of the owner, as land, the public funds, money lent on mortgage, and shares in stock companies. Except the proposal of applying a sponge to the national debt, no such palpable violation of common honesty has found sufficient support in this country, during the present generation, to be regarded as within the domain of discussion. It has not the palliation of a graduated property tax, that of laying the burden on those best able to bear it, for realized property includes the far larger portion of the provision made for those who are unable to work, and consists in great part of extremely small fractions. I can hardly conceive a more shameless pretension than that the major part of the property of the country, that of merchants, manufacturers, farmers, and shopkeepers, should be exempted from its share of taxation, that these classes should only begin to pay their proportion after retiring from business, and if they never retire should be excused from it altogether. But even this does not give an adequate idea of the injustice of the proposition. the burden thus exclusively thrown on the owners of the smaller portion of the wealth of the community would not even be a burden on that class of persons in perpetual succession, but would fall exclusively on those who happened to compose it when the tax was laid on. As land and those particular securities would thenceforth yield a smaller net income, relatively to the general interest of capital and to the profits of trade, the balance would rectify itself by a permanent depreciation of those kinds of property. Future buyers would acquire land and securities at a reduction of price, equivalent to the peculiar tax, which tax they would, therefore, escape from paying, while the original possessors would remain burdened with it even after parting with the property, since they would have sold their land or securities at a loss of value equivalent to the fee simple of the tax. Its imposition would thus be tantamount to the confiscation for public uses of a percentage of their property equal to the percentage laid on their income by the tax. Comment: the above proposition has been extended by those in the United States who appealed to class prejudice to a proposal to tax the incomes of those who hold government bonds. It so happened that, for example, the $6 income on a $100 bond of the United States was not, in the war period, deemed a sufficient equivalent for the risk of loaning $100 to the state, and Congress, therefore, agreed to relieve them of taxation. It is the same thing to a lender if he receive 6% directly from the government or if he receive 7%, and is obliged to pay back 1% to the treasury in the form of taxation. But to the government it is another thing, because if it sell a taxed bond at 7% interest, it does not receive back the whole of the 1% tax, but the 1% tax less the expense of levying it. In other words, the government, in the latter case, pays 6% interest plus the cost of levying the tax, and consequently borrowed more cheaply in the form of an untaxed bond, as was the hope when the provision was made. If, then, a tax were now to be put upon the bonds, it would fall exclusively on the present holders of them, for, since it diminishes the net income from the bond, it lowers the selling price of the bond itself, as before explained. End comment. Section 4. Should the same percentage be levied on perpetual and on terminable incomes? Whether the profits of trade may not rightfully be taxed at a lower rate than incomes derived from interest or rent is part of the more comprehensive question whether life incomes should be subjected to the same rate of taxation as perpetual incomes, whether salaries, for example, or annuities, or the gains of professions, should pay the same percentage as the income from inheritable property. The existing tax in England treats all kinds of incomes exactly alike, taking its 5p in the pound as well from the person whose income dies with him as from the landholder, stockholder, or mortgagee who can transmit his fortune undiminished to his descendants. This is a visible injustice, yet it does not arithmetically violate the rule that taxation ought to be in proportion to means. When it is said that the temporary income ought to be taxed less than a permanent one, the reply is irresistible that it is taxed less, for the income which lasts only 10 years pays the tax only 10 years, while that which lasts forever pays forever. The claim in favor of terminable incomes does not rest on grounds of arithmetic, but of human wants and feelings. It is not because the temporary annuitant has smaller means, but because he has greater necessities, that he ought to be assessed at a lower rate. In spite of the nominal equality of income, A, an annuitant of £1,000 a year, cannot so well afford to pay £100 out of it as B, who derives the same annual sum from heritable property. A having usually a demand on his income which B has not, namely, to provide by saving for children or others, to which, in the case of salaries or professional gains, must generally be added a provision for his own later years, while B may expend his whole income without injury to his old age, and still have it all to bestow on others after his death. If A, in order to meet these exigencies, must lay by £300 of his income, to take £100 from him as income tax is to take £100 from £700, since it must be retrenched from that part only of his means which he can afford to spend on his own consumption. Were he to throw it ratably on what he spends and on what he saves, abating £70 from his consumption and £30 from his annual saving, then indeed his immediate sacrifice would be proportionally the same as B's. But then his children or his old age would be worse provided for in consequence of the tax. The capital sum which would be accumulated for them would be 1/10 less, and on the reduced income afforded by this reduced capital they would be a second time charged with income tax, while B's heirs would only be charged once. The principle, therefore, of equality of taxation, interpreted in its only just sense, equality of sacrifice, requires that a person who has no means of providing for old age, or for those in whom he is interested, except by saving from income, should have the tax remitted on all that part of his income which is really and bona fide applied to that purpose. If, indeed, reliance could be placed on the conscience of the contributors, or sufficient security taken for the correctness of their statements by collateral precautions, the proper mode of assessing an income tax would be to tax only the part of income devoted to expenditure, exempting that which is saved. For when saved and invested, and all savings, speaking generally, are invested, it thenceforth pays income tax on the interest or profit which it brings, notwithstanding that it has already been taxed on the principal. Unless, therefore, savings are exempted from income tax, the contributors are twice taxed on what they save, and only once on what they spend. To tax the sum invested, and afterward tax also the proceeds of the investment, is to tax the same portion of the contributor's means twice over. No income tax is really just from which savings are not exempted, and no income tax ought to be voted without that provision, if the form of the returns and the nature of the evidence required could be so arranged as to prevent the exemption from being taken fraudulent advantage of, by saving with one hand and getting into debt with the other, or by spending in the following year what had been passed tax-free as saving in the year preceding. But if no plan can be devised for the exemption of actual savings sufficiently free from liability to fraud, it is necessary, as the next thing in point of justice, to take into account, in assessing the tax, what the different classes of contributors ought to save. In fixing the proportion between the two rates, there must inevitably be something arbitrary. Perhaps a deduction of 1/4 in favor of life incomes would be as little objectionable as any which could be made. Of the net profits of persons in business, a part, as before observed, may be considered as interest on capital, and of a perpetual character, and the remaining part as remuneration for the skill and labor of superintendents. The surplus beyond interest depends on the life of the individual, and even on his continuance in business, and is entitled to the full amount of exemption allowed to terminable incomes. Section 5. The increase of the rent of land from natural causes a fit subject of peculiar taxation. Suppose that there is a kind of income which constantly tends to increase, without any exertion or sacrifice on the part of the owners. Those owners constituting a class in the community whom the natural course of things progressively enriches, consistently with complete passiveness on their own part. In such a case it would be no violation of the principles on which private property is grounded if the state should appropriate this increase of wealth, or part of it, as it arises. This would not properly be taking anything from anybody, it would merely be applying an accession of wealth, created by circumstances, to the benefit of society, instead of allowing it to become an unearned appendage to the riches of a particular class. Now, this is actually the case with rent. The ordinary progress of a society which increases in wealth is at all times tending to augment the incomes of landlords, to give them both a greater amount and a greater proportion of the wealth of the community, independently of any trouble or outlay incurred by themselves. They grow richer, as it were, in their sleep, without working, risking, or economizing. What claim have they on the general principle of social justice to this accession of riches? In what would they have been wronged if society had, from the beginning, reserved the right of taxing the spontaneous increase of rent to the highest amount required by financial exigencies? The only admissible mode of proceeding would be by a general measure. The first step should be a valuation of all the land in the country. The present value of all land should be exempt from the tax. But after an interval had elapsed, during which society had increased in population and capital, a rough estimate might be made of the spontaneous increase which had accrued to rent since the valuation was made. Of this the average price of produce would be some criterion. If that had risen, it would be certain that rent had increased, and, as already shown, even in a greater ratio than the rise of price. On this and other data, an approximate estimate might be made how much value had been added to the land of the country by natural causes. And in laying on a general land tax, which for fear of miscalculation should be considerably within the amount thus indicated, there would be an assurance of not touching any increase of income which might be the result of capital expended or industry exerted by the proprietor. With reference to such a tax, perhaps a safer criterion than either a rise of rents or a rise of the price of corn would be a general rise in the price of land. It would be easy to keep the tax within the amount which would reduce the market value of land below the original valuation, and up to that point, whatever the amount of the tax might be, no injustice would be done to the proprietors. Comment: In 1870, Mr. Mill became president of the Land Tenure Association, one of whose objects was to claim for the benefit of the state the interception, by taxation, of the future unearned increase of the rent of land, so far as the same can be ascertained, or a great part of that increase, which is continually taking place, without any effort or outlay by the proprietors, merely through the growth of population and wealth, reserving to owners the option of relinquishing their property to the state at the market value which it may have acquired at the time when this principle may be adopted by the legislator. It is urged against this plan that, if the government take for itself the increase from rent, it should also make compensation for loss arising from declining rents, whenever there happens to be any readjustment of values in land. End comment. Section 6. Taxes falling on capital not necessarily objectionable. In addition to the preceding rules, another general rule of taxation is sometimes laid down, namely that it should fall on income and not on capital. To provide that taxation shall fall entirely on income and not at all on capital is beyond the power of any system of fiscal arrangements. There is no tax which is not partly paid from what would otherwise have been saved, no tax the amount of which, if remitted, would be wholly employed in increased expenditure, and no part whatever laid by as an addition to capital. All taxes, therefore, are in some sense partly paid out of capital, and in a poor country it is impossible to impose any tax which will not impede the increase of the national wealth. But in a country where capital abounds and the spirit of accumulation is strong, this effect of taxation is scarcely felt. To take from capital by taxation what emigration would remove, or a commercial crisis destroy, is only to do what either of those causes would have done, namely, to make a clear space for further saving. I cannot therefore attach any importance in a wealthy country to the objection made against taxes on legacies and inheritances, that they are taxes on capital. It is perfectly true that they are so. As Ricardo observes, If £100 are taken from any one in a tax on houses or on wine, he will probably save it, or a part of it, by living in a cheaper house, consuming less wine, or retrenching from some other of his expenses. But if the same sum be taken from him because he has received a legacy of £1,000, he considers the legacy as only £900 and feels no more inducement than at any other time, probably feels rather less inducement, to economize in his expenditure. The tax, therefore, is wholly paid out of capital, and there are countries in which this would be a serious objection. But, in the first place, the argument cannot apply to any country which has a national debt and devotes any portion of revenue to paying it off, since the produce of the tax thus applied still remains capital, and is merely transferred from the taxpayer to the fundholder. But the objection is never applicable in a country which increases rapidly in wealth. End of Book 5, Chapter 1.
Book 5, Chapter 2 of Principles of Political Economy. This is a LibriVox recording. All LibriVox recordings are in the public domain. For more information or to volunteer, please visit LibriVox.org. Recording by Shasta, Oakland, California. Principles of Political Economy by John Stuart Mill. Abridged by J. Laurence LAUGHLIN. Of Direct Taxes. Section 1. Direct taxes either on income or expenditure. Taxes are either direct or indirect. A direct tax is one which is demanded from the very persons who, it is intended or desired, should pay it. Indirect taxes are those which are demanded from one person in the expectation and in intention that he shall indemnify himself at the expense of another, such as the excise or customs. The producer or importer of a commodity is called upon to pay tax on it, not with the intention to levy a peculiar contribution upon him, but to tax through him the consumers of the commodity, from whom it is supposed that he will recover the amount by means of an advance in price. Direct taxes are either on income or on expenditure. Most taxes on expenditure are indirect, but some are direct, being imposed not on the producer or seller of an article, but immediately on the consumer. A house tax, for example, is a direct tax on expenditure, if levied, as it usually is, on the occupier of the house. If levied on the builder or owner, it would be an indirect tax. A window tax is a direct tax on expenditure. So are the taxes on horses and carriages. The sources of income are rent, profits, and wages. These include every sort of income except gift or plunder. Taxes may be laid on any one of the three kinds of income, or a uniform tax on all of them. We will consider these in their order. Section 2. Taxes on rent. A tax on rent falls wholly on the landlord. There are no means by which he can shift the burden upon anyone else. It does not affect the value or price of agricultural produce, for this is determined by the cost of production in the most unfavorable circumstances, and in those circumstances, as we have so often demonstrated, no rent is paid. This, however, is in strict exactness only true of the rent which is the result either of natural causes or of improvements made by tenants. When the landlord makes improvements which increase the productive power of his land, he is remunerated for them by an extra payment from the tenant, and this payment, which to the landlord is properly a profit on capital, is blended and confounded with rent. A tax on rent, if extending to this portion of it, would discourage landlords from making improvements, but whatever hinders improvements from being made in the manner in which people prefer to make them will often prevent them from being made at all, and on this account a tax on rent would be inexpedient unless some means could be devised of excluding from its operation that portion of the nominal rent which may be regarded as landlord's profit. Section 3. On profits. A tax on profits, like a tax on rent, must, at least in its immediate operation, fall wholly on the payer. All profits being alike affected, no relief can be obtained by a change of employment. If a tax were laid on the profits of any one branch of productive employment, the tax would be virtually an increase of the cost of production, and the value and price of the article would rise accordingly, by which the tax would be thrown upon the consumers of the commodity, and would not affect profits. But a general and equal tax on all profits would not affect general prices, and would fall, at least in the first instance, on capitalists alone. There is, however, an ulterior effect, which in a rich and prosperous country requires to be taken into account. It may operate in two different ways. 1. The curtailment of profit, and the consequent increased difficulty in making a fortune or obtaining a subsistence by the employment of capital, may act as a stimulus to inventions and to the use of them when made. If improvements in production are much accelerated, and if these improvements cheapen directly or indirectly any of the things habitually consumed by the laborer, profits may rise, and rise sufficiently to make up for all that is taken from them by the tax. In that case, the tax will have been realized without loss to anyone, the produce of the country being increased by an equal, or what would in that case be a far greater, amount. The tax, however, must even in this case be considered as paid from profits, because the receivers of profits are those who would be benefited if it were taken off. But 2. Though the artificial abstraction of a portion of profits would have a real tendency to accelerate improvements in production, no considerable improvements might actually result, or only of such a kind as not to raise general profits at all, or not to raise them so much as the tax had diminished them. If so, the rate of profit would be brought closer to that practical minimum to which it is constantly approaching. At its first imposition, the tax falls wholly on profits, but the amount of increase of capital which the tax prevents would, if it had been allowed to continue, have tended to reduce profits to the same level. And at every period of 10 or 20 years, there will be found less difference between profits as they are and profits as they would in that case have been, until at last there is no difference, and the tax is thrown either upon the laborer or upon the landlord. The real effect of a tax on profits is to make the country possess at any given period a smaller capital and a smaller aggregate production, and to make the stationary state be attained earlier, and with a smaller sum of national wealth. Even in countries which do not accumulate so fast as to be always within a short interval of the stationary state, it seems impossible that if capital is accumulating at all, its accumulation should not be in some degree retarded by the abstraction of a portion of its profit, and unless the effect in stimulating improvements be a full counterbalance, it is inevitable that a part of the burden will be thrown off the capitalist upon the laborer or the landlord. One or other of these is always the loser by a diminished rate of accumulation. If population continues to increase as before, the laborer suffers. If not, cultivation is checked in its advance, and the landlord loses the accession of rent which would have accrued to them. The only countries in which a tax on profits seems likely to be permanently a burden on capitalists exclusively are those in which capital is stationary, because there is no new accumulation. In such countries, the tax might not prevent the old capital from being kept up through habit or from unwillingness to submit to impoverishment, and so the capitalists might continue to bear the whole of the tax. Section 4. On wages. We now turn to taxes on wages. The incidence of these is very different according as the wages taxed as those of ordinary unskilled labor, or are the remuneration of such skilled or privileged employments, whether manual or intellectual, as are taken out of the sphere of competition by a natural or conferred monopoly. I have already remarked that in the present low state of popular education, all the higher grades of mental or educated labor are at a monopoly price, exceeding the wages of common workmen in a degree very far beyond that which is due to the expense, trouble, and loss of time required in qualifying for the employment. Any tax levied on these gains, which still leaves them above, or not below, their just proportion, falls on those who pay it. They have no means of relieving themselves at the expense of any other class. The same thing is true of ordinary wages in cases like that of the United States or of a new colony, where capital increasing as rapidly as population can increase, wages are kept up by the increase of capital, and not by the adherence of the laborers to a fixed standard of comforts. In such a case, some deterioration of their condition, whether by a tax or otherwise, might possibly take place without checking the increase of population. The tax would in that case fall on the laborers themselves, and would reduce them permanently to that lower state to which, on the same supposition with regard to their habits, they would in any case have been reduced ultimately by the inevitable diminution in the rate of increase of capital. through the occupation of all the fertile land. Some will object that even in this case a tax on wages cannot be detrimental to the laborers, since the money raised by it, being expended in the country, comes back to the laborers again through the demand for labor. Without, however, reverting to general principles, we may rely on an obvious reductio ad absurdum. If to take money from the laborers and spend it in commodities is giving it back to the laborers, then to take money from other classes and spend it in the same manner must be giving it to the laborers. Consequently, the more a government takes in taxes, the greater will be the demand for labor, and the more opulent the condition of the laborers, a proposition the absurdity of which no one can fail to see. In the condition of most communities, wages are regulated by the habitual standard of living to which the laborers adhere, and on less than which they will not multiply. Where there exists such a standard, a tax on wages will, indeed, for a time be borne by the laborers themselves, but, unless this temporary depression has the effect of lowering the standard itself, the increase of population will receive a check which will raise wages and restore the laborers to their previous condition. On whom, in this case, will the tax fall? A rise of wages occasioned by a tax must, like any other increase of the cost of labor, be defrayed from profits. The attempt to tax day laborers in an old country is merely to impose an extra tax upon all employers of common labor, unless the tax has the much worse effect of permanently lowering the standard of comfortable subsistence in the minds of the poorest class. We find in the preceding considerations an additional argument for the opinion already expressed, that direct taxation should stop short of the class of incomes which do not exceed what is necessary for healthful existence. These very small incomes are mostly derived from manual labor, and, as we now see, any tax imposed on these either permanently degrades the habits of the laboring class, or falls on profits and burdens capitalists with an indirect tax, in addition to their share of the direct taxes, which is doubly objectionable, both as a violation of the fundamental rule of equality, and for reasons which, as already shown, render a peculiar tax on profits detrimental to the public wealth, and consequently to the means which society possesses of paying any taxes whatever. Section 5. On income. We now pass from taxes on the separate kinds of income to a tax attempted to be assessed fairly upon all kinds, in other words, an income tax. The discussion of the conditions necessary for making this tax consistent with justice has been anticipated in the last chapter. We shall suppose, therefore, that these conditions are complied with. They are, first, that incomes below a certain amount should be altogether untaxed. This minimum should not be higher than the amount which suffices for the necessaries of the existing population. The second condition is that incomes above the limit should be taxed only in proportion to the surplus by which they exceed the limit. Thirdly, that all sums saved from income and invested should be exempt from the tax, or, if this be found impracticable, that life incomes and incomes from business and professions should be less heavily taxed than inheritable incomes. An income tax fairly assessed on these principles would be, in point of justice, the least exceptionable of all taxes. The objection to it, in the present state of public morality, is the impossibility of ascertaining the real incomes of the contributors. Notwithstanding, too, what is called the inquisitorial nature of the tax, no amount of inquisitorial power which would be tolerated by a people the most disposed to submit to it could enable the revenue officers to assess the tax from actual knowledge of the circumstances of the contributors. Rent, salaries, annuities, and all fixed incomes can be exactly ascertained, but the variable gains of professions, and still more the profits of business, which the person interested cannot always himself exactly ascertain, can still less be estimated with any approach of fairness by a tax collector. The main reliance must be placed, and always has been placed, on the returns made by the person himself. The tax, therefore, on whatever principles of equality it may be imposed, is in practice unequal in one of the worst ways, falling heaviest on the most conscientious. It is to be feared, therefore, that the fairness which belongs to the principle of an income tax cannot be made to attach to it in practice. This consideration would lead us to concur in the opinion which until of late has usually prevailed, that direct taxes on income should be reserved as an extraordinary resource for great national emergencies, in which the necessity of a large additional revenue overrules all objections. The difficulties of a fair income tax have elicited a proposition for a direct tax of so much per cent, not on income, but on expenditure. The aggregate amount of each person's expenditure being ascertained, as the amount of income now is, from statements furnished by the contributors themselves. The only security would still be the veracity of the individuals, and there is no reason for supposing that their statements would be more trustworthy on the subject of their expenses than on that of their revenues. The taxes on expenditure at present in force, either in this or in other countries, fall only on particular kinds of expenditure, and differ no otherwise from taxes on commodities than in being paid directly by the person who consumes or uses the article, instead of being advanced by the producer or seller and reimbursed in the price. The taxes on horses and carriages, on dogs, on servants, are of this nature. They evidently fall on the persons from whom they are levied, those who use the commodity taxed. A tax of a similar description, and more important, is a house tax, which must be considered at some greater length. Section 6. A house tax. The rent of a house consists of two parts, the ground rent and what Adam Smith called the building rent. The first is determined by the ordinary principles of rent. It is the remuneration given for the use of the portion of land accompanied by the house and its appurtenances, and varies from a mere equivalent for the rent which the ground would afford in agriculture to the monopoly rents paid for advantageous situations in populous thoroughfares. The rent of the house itself, as distinguished from the ground, is the equivalent given for the labor and capital expended on the building. The fact of its being received in quarterly or half-yearly payments makes no difference in the principles by which it is regulated. It comprises the ordinary profit on the builder's capital and an annuity sufficient at the current rate of interest after paying for all repairs chargeable on the proprietor to replace the original capital by the time the house is worn out or by the expiration of the usual term of a building lease. A tax of so much per cent on the gross rent falls on both those portions alike. The more highly a house is rented, the more it pays to the tax, whether the quality of the situation or that of the house itself is the cause. The incidence, however, of these two portions of the tax must be considered separately. As much of it as is a tax on building rent must ultimately fall on the consumer, in other words, the occupier. For, as the profits of building are already not above the ordinary rate, they would, if the tax fell on the owner and not on the occupier, become lower than the profits on untaxed employments, and houses would not be built. It is probable, however, that for some time after the tax was first imposed, a great part of it would fall not on the renter, but on the owner of the house. A large proportion of the consumers either could not afford or would not choose to pay their former rent with the tax in addition, but would content themselves with a lower scale of accommodation. Houses, therefore, in the case of most other articles, would be an almost immediate diminution of the supply. But so durable a commodity as houses does not rapidly diminish in amount. New buildings, indeed, of the class for which the demand had decreased, would cease to be erected except for special reasons. But in the meantime, the temporary superfluity would lower rents, and the consumers would obtain perhaps nearly the same accommodation as formerly. For the same aggregate payment, rent and tax together. By degrees, however, as the existing houses wore out, or as increase of population demanded a greater supply, rents would again rise until it became profitable to recommence building, which would not be until the tax was wholly transferred to the occupier. In the end, therefore, the occupier bears that proportion of the tax on rent which falls on the payment made for the house itself, exclusively of the ground it stands on. The case is partly different with the portion which is a tax on ground rent. As taxes on rent, properly so called, fall on the landlord, a tax on ground rent, one would suppose, must fall on the ground landlord, at least after the expiration of the building lease. It will not, however, fall wholly on the landlord, unless with the tax on ground rent there is combined an equivalent tax on agricultural rent. The lowest rent of land let for building is very little above the rent which the same ground would yield in agriculture. Since it is reasonable to suppose that land, unless in case of exceptional circumstances, is let or sold for building as soon as it is decidedly worth more for that purpose than for cultivation. If, therefore, a tax were laid on ground rents without being also laid on agricultural rents, it would, unless of trifling amount, reduce the return from the lowest ground rents below the ordinary return from land, and would check further building quite as effectually as if it were a tax on building rents, until either the increased demand of a growing population or a diminution of supply by the ordinary causes of destruction had raised the rent by a full equivalent for the tax. But whatever raises the lowest ground rents raises all others, since each exceeds the lowest by the market value of its peculiar advantages. If, therefore, the tax on ground rents were a fixed sum per square foot, the more valuable situations paying no more than those least in request, this fixed payment would ultimately fall on the occupier. Suppose the lowest ground rent to be $50 per acre, and the highest $5,000. A tax of $5 per acre on ground rents would ultimately raise the former to $55, and the latter consequently to $5,005, since the difference of value between the two situations would be exactly what it was before. The annual $5, therefore, would be paid by the occupier, but a tax on ground rent is supposed to be a portion of a house tax, which is not a fixed payment, but a percentage on the rent. The cheapest site, therefore, being supposed, as before, to pay $5, the dearest would pay $500, of which only $5 could be thrown upon the occupier, since the rent would still be only raised to $5,005. Consequently, $495 of the $500 levied from the expensive site would fall on the ground landlord. A house tax thus requires to be considered in a double aspect, as a tax on all occupiers of houses, and a tax on ground rents. In the vast majority of houses, the ground rent forms but a small proportion of the annual payment made for the house, and nearly all the tax falls on the occupier. It is only in exceptional cases, like that of the favorite situations in large towns, that the predominant element in the rent of the house is the ground rent, and among the very few kinds of income which are fit subjects for peculiar taxation, these ground rents hold the principal place, being the most gigantic example extant of enormous accessions of riches acquired rapidly, and in many cases unexpectedly by a few families, from the mere accident of their possessing certain tracts of land without their having themselves aided in the acquisition by the smallest exertion, outlay, or risk. So far, therefore, as a house tax falls on the ground landlord, it is liable to no valid objection. In so far as it falls on the occupier, if justly proportioned to the value of the house, it is one of the fairest and most unobjectionable of all taxes. No part of a person's expenditure is a better criterion of his means, or bears, on the whole, more nearly the same proportion to them. The equality of this tax can only be seriously questioned on two grounds. The first is that a miser may escape it. This objection applies to all taxes on expenditure. Nothing but a direct tax on income can reach a miser. The second objection is that a person may require a larger and more expensive house, not from having greater means, but from having a larger family. Of this, however, he is not entitled to complain, since having a large family is at a person's own choice, and so far as concerns the public interest, is a thing rather to be discouraged than promoted. Footnote. Another common objection is that large and expensive accommodation is often required not as a residence but for business. But it is an admitted principle that buildings or portions of buildings occupied exclusively for business, such as shops, warehouses, or manufactories, ought to be exempted from house tax. It has been also objected that house rent in the rural districts is much lower than in towns, and lower in some towns and in some rural districts than in others, so that a tax proportioned to it would have a corresponding inequality of pressure. To this, however, it may be answered that in places where house rent is low, persons of the same amount of income usually live in larger and better houses, and thus expend in house rent more nearly the same proportion of their incomes than might at first sight appear, or, if not, the probability will be that many of them live in those places precisely because they are too poor to live elsewhere, and have, therefore, the strongest claim to be taxed lightly. In some cases, it is precisely because the people are poor that the house rent remains low. End of footnote. A valuation should be made of the house, not at what it would sell for, but at what would be the cost of rebuilding it, and this valuation might be periodically corrected by an allowance for what it had lost in value by time, or gained by repairs and improvements. The amount of the amended valuation would form a principal sum, the interest of which, at the current price of the public funds, would form the annual value at which the building should be assessed to the tax. As incomes below a certain amount ought to be exempt from income tax, so ought houses below a certain value from house tax, on the universal principle of sparing from all taxation the absolute necessaries of healthful existence, in order that the occupiers of lodgings as well as of houses might benefit, as in justice they ought, by this exemption. It might be optional with the owners to have every portion of a house which is occupied by a separate tenant valued and assessed separately. End of Book 5, Chapter 2.
Book 5, Chapter 3, Part 1 of Principles of Political Economy. This is a LibriVox recording. All LibriVox recordings are in the public domain. For more information or to volunteer, visit LibriVox.org. Principles of Political Economy by John Stuart Mill. Abridged, with critical, bibliographical, and explanatory notes and a sketch of the history of political economy by J. Laurence LAUGHLIN. Book 5, Chapter 3 of Taxes on Commodities or Indirect Taxes. 1. A tax on all commodities would fall on profits. By taxes on commodities are commonly meant those which are levied either on the producers or on the carriers or dealers who intervene between them and the final purchasers for consumption. The phrase being, by custom, confined to indirect taxes, those which are advanced by one person, to be, as is expected and intended, reimbursed by another. Taxes on commodities are either on production within the country, or on importation into it, or on conveyance or sale within it, and are classed respectively as excise, customs, or tolls and transit duties. To whichever class they belong, and at whatever stage in the progress of the community they may be imposed, they are equivalent to an increase of the cost of production, using that term in its most enlarged sense, which includes the cost of transport and distribution, or, in common phrase, of bringing the commodity to market. When the cost of production is increased artificially by a tax, the effect is the same as when it is increased by natural causes. If only one or a few commodities are affected, their value and price rise so as to compensate the producer or dealer for the peculiar burden. But if there were a tax on all commodities exactly proportioned to their value, no such compensation would be obtained. There would neither be a general rise of values, which is an absurdity, nor of prices, which depend on causes entirely different. There would, however, as Mr. McCulloch has pointed out, be a disturbance of values, some falling, others rising, owing to a circumstance, the effect of which on values and prices we formerly discussed, the different durability of the capital employed in different occupations. The gross produce of industry consists of two parts, one portion serving to replace the capital consumed, while the other portion is profit. Now, with equal capital in two branches of production, must have equal expectations of profit. But if a greater portion of the one than of the other is fixed capital, or if that fixed capital is more durable, there will be a less consumption of capital in the year, and less will be required to replace it, so that the profit, if absolutely the same, will form a greater proportion of the annual returns. To derive from a capital of $1,000 a profit of $100, the one producer may have to sell to the value of $1,100, the other only to the value of $500. If on these two branches of industry a tax be imposed of 5% ad valorem, the last will be charged only with $25, the first with $55, leaving to the one $75 profit, to the other only $45. To equalize, therefore, their expectation of profit, the one commodity must rise in price, or the other must fall, or both. Commodities made chiefly by immediate labor must rise in value, as compared with those which are chiefly made by machinery. It is unnecessary to prosecute this branch of the inquiry any further. 2. Taxes on particular commodities fall on the consumer. A tax on any one commodity, whether laid on its production, its importation, its carriage from place to place, or its sale, and whether the tax be a fixed sum of money for a given quantity of the commodity, or an ad valorem duty, will, as a general rule, raise the value and price of the commodity by at least the amount of the tax. There are few cases in which it does not raise them by more than that amount. In the first place, there are few taxes on production on account of which it is not found or deemed necessary to impose restrictive regulations on the manufacturers or dealers in order to check evasions of the tax. These regulations are always sources of trouble and annoyance, and generally of expense, for all of which, being peculiar disadvantages, the producers or dealers must have compensation in the price of their commodity. These restrictions also frequently interfere with the processes of manufacture, requiring the producer to carry on his operations in the way most convenient to the revenue, though not the cheapest or most efficient for purposes of production. Any regulations whatever, enforced by law, make it difficult for the producer to adopt new and improved processes. Further, the necessity of advancing the tax obliges producers and dealers to carry on their business with greater capitals than would otherwise be necessary, on the whole of which they must receive the ordinary rate of profit, though a part only is employed in defraying the real expenses of production or importation. The price of the article must be such as to afford a profit on more than its natural value, instead of a profit on only its natural value. Neither ought it to be forgotten that whatever renders a larger capital necessary in any trade or business limits the competition in that business, and by giving something like a monopoly to a few dealers, may enable them either to keep up the price beyond what would afford the ordinary rate of profit, or to obtain the ordinary rate of profit with a less degree of exertion for improving and cheapening their commodity. In these several modes, taxes on commodities often cost to the consumer, through the increased price of the article, much more than they bring into the treasury of the state. There is still another consideration. The higher price necessitated by the tax almost always checks the demand for the commodity, and since there are many improvements in production which, to make them practicable, require a certain extent of demand, such improvements are obstructed, and many of them prevented altogether. It is a well-known fact that the branches of production in which fewest improvements are made are those with which the revenue officer interferes, and that nothing, in general, gives a greater impulse to improvements in the production of a commodity than taking off a tax which narrowed the market for it. 3. Peculiar effects of taxes on necessaries. Such are the effects of taxes on commodities, considered generally. But as there are some commodities, those composing the necessaries of the laborer, of which the values have an influence on the distribution of wealth among different classes of the community, it is requisite to trace the effects of taxes on those particular articles somewhat further. If a tax be laid, say, on corn, and the price rises in proportion to the tax, the rise of price may operate in two ways. First, it may lower the condition of the laboring classes. Temporarily, indeed, it can scarcely fail to do so. If it diminishes their consumption of the produce of the earth, or makes them resort to a food which the soil produces more abundantly, and therefore more cheaply, it to that extent contributes to throw back agriculture upon more fertile lands or less costly processes, and to lower the value and price of corn, which therefore ultimately settles at a price, increased not by the whole amount of the tax, but by only a part of its amount. Secondly, however, it may happen that the dearness of the taxed food does not lower the habitual standard of the laborer's requirements, but that wages, on the contrary, through an action on population, rise in shorter or longer periods so as to compensate the laborers for their portion of the tax, the compensation being, of course, at the expense of profits. Taxes on necessaries must have one of two effects. Either they lower the condition of the laboring classes, or they exact from the owners of capital in addition to the amount due to the state on their own necessaries, the amount due on those consumed by the laborers. In the last case, the tax on necessaries, like a tax on wages, is equivalent to a peculiar tax on profits, which is, like all other partial taxation, unjust, and is specially prejudicial to the increase of the national wealth. It remains to speak of the effect on rent, assuming, what is usually the fact, that the consumption of food is not diminished. The same cultivation as before will be necessary to supply the wants of the community. The margin of cultivation, to use Dr. Chalmers' expression, remains where it was, and the same land or capital which, as the least productive, already regulated the value and price of the whole produce, will continue to regulate them. The effect which a tax on agricultural produce will have on rent depends on its affecting or not affecting the difference between the return to this least productive land or capital and the returns to other lands and capitals. Now, this depends on the manner in which the tax is imposed. If it is an ad valorem tax, or what is the same thing, a fixed proportion of the produce, such as tithe, for example, it evidently lowers corn rents, for it takes more corn from the better lands than from the worse, and exactly in the degree in which they are better, land of twice the productiveness paying twice as much to the tithe. Whatever takes more from the greater of two quantities than from the less diminishes the difference between them. The imposition of a tithe on corn would take a tithe also from corn rent, for if we reduce a series of numbers by a tenth each, the differences between them are reduced 1/10. For example, let there be 5 qualities of land, which severally yield, on the same extent of ground and with the same expenditure, 100, 90, 80, 70, and 60 bushels of wheat, the last of these being the lowest quality which the demand for food renders it necessary to cultivate. The rent on these lands will be as follows. The land producing 100 bushels will yield a rent of 100 minus 60, or 40 bushels. That producing 90 bushels, a rent of 90 minus 60, or 30 bushels. That producing 80 bushels, a rent of 80 minus 60, or 20 bushels. That producing 700 bushels, a rent of 70 minus 60, or 10 bushels. That producing 60 bushels will yield no rent. Now, let a tithe be imposed, which takes from these 5 pieces of land 10, 9, 8, 7, and 6 bushels respectively, the 5th quality still being the one which regulates the price, but returning to the farmer, after payment of tithe, no more than 54 bushels. The land producing 100 bushels, reduced to 90, will yield a rent of 90 minus 54, or 36 bushels. That producing 90 bushels, reduced to 81, a rent of 81 minus 54, or 27 bushels. That producing 80 bushels, reduced to 72, a rent of 72 minus 54, or 18 bushels. That producing 70 bushels, reduced to 63, a rent of 63 minus 54, or 9 bushels. And that producing 60 bushels, reduced to 54, will yield as before no rent, so that the rent of the first quality of land has lost 4 bushels, of the second 3, of the third 2, and of the fourth 1. That is, each has lost exactly 1/10. A tax, therefore, of a fixed proportion of the produce lowers in the same proportion corn rent. But it is only corn rent that is lowered, and not rent estimated in money, or in any other commodity. For in the same proportion as corn rent is reduced in quantity, the corn composing it is raised in value. Under the tithe, 54 bushels will be worth in the market what 60 were before, and 9/10 will in all cases sell for as much as the whole 10/10 previously sold for. The landlords will therefore be compensated in value and price for what they lose in quantity, and will suffer only so far as they consume their rent in kind, or after receiving it in money, expend it in agricultural produce. That is, they only suffer as consumers of agricultural produce, and in common with all the other consumers. Considered as landlords, they have the same income as before. The tithe therefore falls on the consumer, and not on the landlord. The same effect would be produced on rent if the tax, instead of being a fixed proportion of the produce, were a fixed sum per quarter or per bushel. A tax which takes a shilling for every bushel takes more shillings from one field than from another, just in proportion as it produces more bushels, and operates exactly like tithe, except that tithe is not only the same proportion on all lands, but is also the same proportion at all times, while a fixed sum of money per bushel will amount to a greater or less proportion according as corn is cheap or dear. There are other modes of taxing agriculture, which would affect rent differently. A tax proportioned to the rent would fall wholly on the rent, and would not at all raise the price of corn, which is regulated by the portion of the produce that pays no rent. A fixed tax of so much per cultivated acre, without distinction of value, would have effects differently the reverse. Taking no more from the best qualities of land than from the worst, it would leave the differences the same as before, and consequently the same corn rents, and the landlords would profit to the full extent of the rise of price. To put the thing in another manner, the price would rise sufficiently to enable the worst land to pay the tax, thus enabling all lands which produce more than the worst to pay not only the tax, but also an increased rent to the landlords. These, however, are not so much taxes on the produce of land as taxes on the land itself. Taxes on the produce, properly so called, whether fixed or ad valorem, do not affect rent, but fall on the consumer. Profits, however, generally bearing either the whole or the greatest part of the portion which is levied on the consumption of the laboring classes. 4. How modified by the tendency of profits to a minimum? The preceding is, I apprehend, a correct statement of the manner in which taxes on agricultural produce operate when first laid on. When, however, they are of old standing, their effect may be different. Now, the effect of accumulation, when attended by its usual accompaniment, an increase of population, is to increase the value and price of food, to raise rent, and to lower profits. That is, to do precisely what is done by a tax on agricultural produce, except that this does not raise rent. The tax, therefore, merely anticipates the rise of price and fall of profits, which would have taken place ultimately through the mere progress of accumulation, while it at the same time prevents, or at least retards, that progress. If the rate of profit was such that the effect of the tithe reduces it to the practical minimum, after a lapse of time which would have admitted of a rise of 1/10 from the natural progress of wealth, the consumer will be paying no more than he would have paid if the tithe had never existed. He will have ceased to pay any portion of it, and the person who will really pay it is the landlord, whom it deprives of the increase of rent which would by that time have accrued to him. At every successive point in this interval of time, less of the burden will rest on the consumer, and more of it on the landlord, and in the ultimate result, the minimum of profits will be reached with a smaller capital and population, and a lower rental than if the course of things had not been disturbed by the imposition of the tax. If, on the other hand, the tithe or other tax on agricultural produce does not reduce profits to the minimum, but to something above the minimum, accumulation will not be stopped, but only slackened. And if population also increases, the twofold increase will continue to produce its effects: a rise of the price of corn and an increase of rent. These consequences, however, will not take place with the same rapidity as if the higher rate of profit had continued. At the end of 20 years, the country will have a smaller population and capital than, but for the tax, it would by that time have had. The landlords will have a smaller rent, and the price of corn, having increased less rapidly than it would otherwise have done, will not be so much as a tenth higher than what, if there had been no tax, it would by that time have become. A part of the tax, therefore, will always have ceased to fall on the consumer and devolved upon the landlord, and the proportion will become greater and greater by lapse of time. But though tithes and other taxes on agricultural produce, when of long standing, either do not raise the price of food and lower profits at all, or, if at all, not in proportion to the tax, yet the abrogation of such taxes, when they exist, does not the less diminish price, and, in general, raise the rate of profit. The abolition of a tithe takes 1/10 from the cost of production, and consequently from the price, of all agricultural produce, and unless it permanently raises the laborer's requirements, it lowers the cost of labor and raises profits. Rent, estimated in money or in commodities, generally remains as before. Estimated in agricultural produce, it is raised. The country adds as much by the repeal of a tithe to the margin which intervenes between it and the stationary state, as was cut off from that margin by the tithe when first imposed. Accumulation is greatly accelerated, and if population also increases, the price of corn immediately begins to recover itself, and rent to rise, thus gradually transferring the benefit of the remission from the consumer to the landlord. End of Book 5, Chapter 3, Part 1. Principles of Political Economy, Book 5, Chapter 3, Part 2. This is a LibriVox recording. All LibriVox recordings are in the public domain. For more information, or to volunteer, visit LibriVox.org. Principles of Political Economy by John Stuart Mill. Abridged, with critical, bibliographical, and explanatory notes, and a sketch of the history of political economy by J. Laurence LAUGHLIN. Book 5, Chapter 3. Section 5. Effects of Discriminating Duties. We have hitherto inquired into the effects of taxes on commodities, on the assumption that they are levied impartially on every mode in which the commodity can be produced or brought to market. Another class of considerations is opened if we suppose that this impartiality is not maintained, and that the tax is imposed not on the commodity, but on some particular mode of obtaining it. Suppose that a commodity is capable of being made by two different processes. As a manufactured commodity may be produced either by hand or by steam power. Sugar may be made either from the sugarcane or from beetroot, cattle fattened either on hay and green crops or on oil cake and the refuse of breweries. It is the interest of the community that, of the two methods, producers should adopt that which produces the best article at the lowest price. This being the interest of the producers, unless protected against competition, and shielded from the penalties of indolence, the process most advantageous to the community is that which, if not interfered with by government, they ultimately find it to their advantage to adopt. Suppose, however, that a tax is laid on one of the processes, and no tax at all, or one of smaller amount, on the other. If the taxed process is the one which the producers would not have adopted, the measure is simply nugatory. But if the tax falls, as it is of course intended to do, upon the one which they would have adopted, it creates an artificial motive for preferring the untaxed process, though the inferior of the two. If, therefore, it has any effect at all, it causes the commodity to be produced of worse quality, or at a greater expense of labor. It causes so much of the labor of the community to be wasted, and the capital employed in supporting and remunerating that labor to be expended as uselessly as if it were spent in hiring men to dig holes and fill them up again. This waste of labor and capital constitutes an addition to the cost of production of the community, which raises its value and price in a corresponding ratio. And thus the owners of the capital are indemnified. The loss falls on the consumers, though the capital of the country is also eventually diminished by the diminution of their means of saving, and, in some degree, of their inducements to save. The kind of tax, therefore, which comes under the general denomination of a discriminating duty, transgresses the rule that taxes should take as little as possible from the taxpayer beyond what they bring into the treasury of the state. A discriminating duty makes the consumer pay two distinct taxes, only one of which is paid to the government, and that frequently the less onerous of the two. If a tax were laid on sugar produced from the cane, leaving the sugar from beetroot untaxed, then insofar as cane sugar continued to be used, the tax on it would be paid to the treasury, and might be as unobjectionable as most other taxes. But if cane sugar, having previously been cheaper than beetroot sugar, was now dearer, and beetroot sugar was to any considerable amount substituted for it, and fields laid out, and manufactories established in consequence, the government would gain no revenue from the beetroot sugar, while the consumers of it would pay a real tax. They would pay for beetroot sugar more than they had previously paid for cane sugar, and the difference would go to indemnify producers for a portion of the labor of the country actually thrown away in producing by the labor of, say, 300 men, what could be obtained by the other process with the labor of 200. Comment by Professor LAUGHLIN. An interesting illustration in late years of the operation of a discriminating duty is to be found in the case of different grades of sugar imported into the United States. Our tariff levied certain duties on different grades of sugar classified by color, on the theory that color was a test of saccharine strength. Cargoes were examined and compared with graded sugars hermetically sealed in glass bottles and distributed by the Dutch authorities, whence came the name of Dutch Standard. Grades from number 1, mulatto, to number 10 must go to the refiner before consumption, but the grades to number 13, although some might have gone into immediate consumption, were usually sent to be manufactured into the highest grades of soft and hard sugars. So long as the sugar was secured by evaporation in open coppers, or by passing the molasses through a layer of clay, saccharine strength and color went fairly well together. But with the invention of the vacuum pan and the centrifugal wheel, by which the sugar is reduced through a shorter and more effective process, sugar of a certain grade of color by the Dutch standard contained a much greater degree of sweetness than that produced by the old methods. Cuban planters, therefore, were permitted to send sugar into this country at a duty which was really levied on grades much inferior, and so paid a less duty than other sugars. The products of one country were discriminated against in favor of another. The difficulty was settled by using the polariscope, which gave an absolute chemical test of the sweetness, irrespective of color. End of comment. One of the commonest cases of discriminating duties is that of a tax on the importation of a commodity capable of being produced at home, unaccompanied by an equivalent tax on the home production. A commodity is never permanently imported unless it can be obtained from abroad at a smaller cost of labor and capital, on the whole, than is necessary for producing it. If, therefore, by a duty on the importation, it is rendered cheaper to produce the article than to import it, an extra quantity of labor and capital is expended without any extra result. The labor is useless, and the capital is spent in paying people for laboriously doing nothing. All custom duties, which operate as an encouragement to the home production of the taxed article, are thus an eminently wasteful mode of raising a revenue. This character belongs in a peculiar degree to custom duties on the produce of land, unless countervailed by excise duties on the home production. Such taxes bring less into the public treasury compared with what they take from the consumers than any other imposts to which civilized nations are usually subject. If the wheat produced in a country is 20 millions of quarters, and the consumption 21 millions, a million being annually imported, and if on this million a duty is laid which raises the price 10 shillings per quarter, the price which is raised is not that of the million only, but of the whole 21 millions. Taking the most favorable, but extremely improbable supposition that the importation is not at all checked, nor the home production enlarged, the state gains a revenue of only 500,000, while the consumers are taxed 10 millions and a half, the 10 millions being a contribution to the home growers, who are forced by competition to resign it all to the landlords. The consumer thus pays to the owners of land an additional tax equal to 20 times that which he pays to the state. Let us now suppose that the tax really checks importation. Suppose importation stopped altogether in ordinary years, it being found that the million of quarters can be obtained by a more elaborate cultivation, or by breaking up inferior land, at a less advance than 10 shillings upon the previous price. Say, for instance, 5 shillings a quarter. The revenue now obtains nothing, except from the extraordinary imports which may happen to take place in a season of scarcity. But the consumers pay every year a tax of 5 shillings on the whole 21 millions of quarters, amounting to 5,250,000 pounds sterling. Of this, the original 250,000 pounds goes to compensate the growers of the last million of quarters for the labor and capital wasted under the compulsion of the law. The remaining 5 million pounds go to enrich the landlords as before. Such is the operation of what are technically termed corn laws when first laid on, and such continues to be their operation so long as they have any effect at all in raising the price of corn. The difference between a country without corn laws and a country which has long had corn laws is not so much that the last has a higher price or a larger rental, but that it has the same price and the same rental with a smaller aggregate capital and a smaller population. The imposition of corn laws raises rents, but retards that progress of accumulation which would in no long period have raised them fully as much. The repeal of corn laws tends to lower rent, but it unchains a force which, in a progressive state of capital and population, restores and even increases the former amount. What we have said of duties on importation generally is equally applicable to discriminating duties which favor importation from one place, or in one particular manner, in contradistinction to others, such as the preference given to the produce of a colony, or of a country with which there is a commercial treaty, or the higher duties formerly imposed by our navigation laws on goods imported in other than British shipping. Whatever else may be alleged in favor of such distinctions, whenever they are not nugatory, they are economically wasteful. They induce a resort to a more costly mode of obtaining a commodity in lieu of one less costly, and thus cause a portion of the labor which the country employs in providing itself with foreign commodities to be sacrificed without return. 6. Effects produced on international exchange by duties on exports and on imports. There is one more point relating to the operation of taxes on commodities conveyed from one country to another, which requires notice: the influences which they exert on international exchanges. Every tax on a commodity tends to raise its price, and consequently to lessen the demand for it in the market in which it is sold. All taxes on international trade tend therefore to produce a disturbance and a readjustment of what we have termed the equation of international demand. Taxes on foreign trade are of two kinds: taxes on imports and on exports. On the first aspect of the matter, it would seem that both these taxes are paid by the consumers of the commodity. The taxes on exports consequently fall entirely on foreigners, taxes on imports wholly on the home consumer. The true state of the case, however, is much more complicated. Quote, "By taxing exports we may, in certain circumstances, produce a division of the advantage of the trade more favorable to ourselves. In some cases we may draw into our coffers, at the expense of foreigners, not only the whole tax, but much more than the tax. In other cases we shall gain exactly the tax. In others, less than the tax. In this last case, a part of the tax is borne by ourselves, possibly the whole, possibly even, as we shall show, more than the whole." End quote. Reverting to the supposititious case employed of a trade between England and the United States in iron and corn, suppose that the United States taxes her export of corn, the tax not being supposed high enough to induce England to produce corn for herself. The price at which corn can be sold in England is augmented by the tax. This will probably diminish the quantity consumed. It may diminish it so much that, even at the increased price, there will not be required so great a money value as before. Or it may not diminish it at all, or so little that, in consequence of the higher price, a greater money value will be purchased than before. In this last case, the United States will gain, at the expense of England, not only the whole amount of the duty, but more. For the money value of her exports to England being increased, while her imports remain the same, money will flow into the United States from England. The price of corn will rise in the United States, and consequently in England, but the price of iron will fall in England, and consequently in the United States. We shall export less corn and import more iron, till the equilibrium is restored. It thus appears, which is at first sight somewhat remarkable, that by taxing her exports, the United States would, in some conceivable circumstances, not only gain from her foreign customers the whole amount of the tax, but would also get her imports cheaper. She would get them cheaper in two ways, for she would obtain them for less money, and she would have more money to purchase them with. England, on the other hand, would suffer doubly. She would have to pay for her corn a price increased not only by the duty, but by the influx of money into the United States, while the same change in the distribution of the circulating medium would leave her less money to purchase it with. This, however, is only one of three possible cases. If, after the imposition of the duty, England requires so diminished a quantity of corn that its total value is exactly the same as before, the balance of trade would be undisturbed. The United States would gain the duty, England will lose it, and nothing more. If, again, the imposition of the duty occasions such a falling off in the demand that England requires a less pecuniary value than before, our exports will no longer pay for our imports. Money must pass from the United States into England, and England's share of the advantage of the trade will be increased. By the change in the distribution of money, corn will fall in the United States, and therefore it will, of course, fall in England. Thus, England will not pay the whole of the tax. For the same cause, iron will rise in England, and consequently in the United States. When this alteration of prices has so adjusted the demand that the corn and the iron again pay for one another, the result is that England has paid only a part of the tax, and the remainder of what has been received into our treasury has come indirectly out of the pockets of our own consumers of iron, who pay a higher price for that imported commodity in consequence of the tax on our exports, while at the same time they, in consequence of the efflux of money and the fall of prices, have smaller money incomes wherewith to pay for the iron at that advanced price. It is not an impossible supposition that by taxing our exports, we might not only gain nothing from the foreigner, the tax being paid out of our own pockets, but might even compel our own people to pay a second tax to the foreigner. Suppose, as before, that the demand of England for corn falls so much on the imposition of the duty that she requires a smaller money value than before, and that the case is so different with iron in the United States that when the price rises, the demand either does not fall off at all, or so little that the money value required is greater than before. The first effect of laying on the duty is, as before, that the corn exported will no longer pay for the iron imported. Money will therefore flow out of the United States into England. One effect is to raise the price of iron in England and consequently in the United States. But this, by the supposition, instead of stopping the efflux of money, only makes it greater, because the higher the price, the greater the money value of the iron consumed. The balance, therefore, can only be restored by the other effect, which is going on at the same time, namely, the fall of corn in the American and consequently in the English market. Even when corn has fallen so low that its price with the duty is only equal to what its price without the duty was at first, it is not a necessary consequence that the fall will stop, for the same amount of exportation as before will not now suffice to pay the increased money value of the imports, and although the English consumers have now not only corn at the old price, but likewise increased money incomes, it is not certain that they will be inclined to employ the increase of their incomes in increasing their purchases of corn. The price of corn, therefore, must perhaps fall to restore the equilibrium, more than the whole amount of the duty. England may be enabled to import corn at a lower price when it is taxed than when it is untaxed, and this gain she will acquire at the expense of the American consumers of iron, who, in addition, will be the real payers of the whole of what is received at their own custom house under the name of duties on the export of corn. In general, however, there could be little doubt that a country which imposed such taxes would succeed in making foreign countries contribute something to its revenue. But unless the taxed article be one for which their demand is extremely urgent, they will seldom pay the whole of the amount which the tax brings in. Comment by Professor Laughlin. The result of this investigation may, then, be generally formulated as follows. That country which has the strongest demand for the commodities of other countries, as compared with the demand of other countries for its own commodities, will pay the burden of the export duty. End comment. Thus far of duties on exports. We now proceed to the more ordinary case of duties on imports. Quote, "We have had an example of a tax on exports, that is, on foreigners, falling in part on ourselves. We shall therefore not be surprised if we find a tax on imports, that is, on ourselves, partly falling upon foreigners. Instead of taxing the corn which we export, suppose that we tax the iron which we import. The duty which we are now supposing must not be what is termed a protecting duty, that is, a duty sufficiently high to induce us to produce the article at home. If it had this effect, it would destroy entirely the trade both in corn and in iron, and both countries would lose the whole of the advantage which they previously gained by exchanging these commodities with one another. We suppose a duty which might diminish the consumption of the article, but which would not prevent us from continuing to import, as before, whatever iron we did consume. The equilibrium of trade would be disturbed if the imposition of the tax diminished, in the slightest degree, the quantity of iron consumed. For, as the tax is levied at our own custom house, the English exporter only receives the same price as formerly, though the American consumer pays a higher one. If, therefore, there be any diminution of the quantity bought, although a larger sum of money may be actually laid out in the article, a smaller one will be due from the United States to England. This sum will no longer be an equivalent for the sum due from England to the United States for corn. The balance, therefore, must be paid in money. Prices will fall in England and rise in the United States. Iron will fall in the English market. Corn will rise in the American. The English will pay a higher price for corn and will have smaller money incomes to buy it with, while the Americans will obtain iron cheaper. That is, its price will exceed what it previously was by less than the amount of the duty, while their means of purchasing it will be increased by the increase of their money incomes. If the imposition of the tax does not diminish the demand, it will leave the trade exactly as it was before. We shall import as much and export as much. The whole of the tax will be paid out of our own pockets. But the imposition of a tax on a commodity almost always diminishes the demand more or less, and it can never, or scarcely ever, increase the demand. It may, therefore, be laid down as a principle that a tax on imported commodities, whether it really operates as a tax and not as a prohibition, either total or partial, almost always falls in part upon the foreigners who consume our goods, and that this is a mode in which a nation may appropriate to itself, at the expense of foreigners, a larger share than would otherwise belong to it of the increase in the general productiveness of the labor and capital of the world, which results from the interchange of commodities among nations." End quote. Those are, therefore, in the right who maintain that taxes on imports are partly paid by foreigners, but they are mistaken when they say that it is by the foreign producer. It is not on the person from whom we buy, but on all those who buy from us, that a portion of our custom duties spontaneously falls. It is the foreign consumer of our exported commodities who is obliged to pay a higher price for them, because we maintain revenue duties on foreign goods. There are but two cases in which duties on commodities can in any degree, or in any manner, fall on the producer. One is when the article is a strict monopoly, and at a scarcity price, the price in this case being only limited by the desires of the buyer, the sum obtained for the restricted supply being the utmost which the buyers would consent to give, rather than go without it. If the Treasury intercepts a part of this, the price cannot be further raised to compensate for the tax, and it must be paid from the monopoly profits. A tax on rare and high-priced wines will fall wholly on the growers, or rather, on the owners of the vineyards. The second case, in which the producer sometimes bears a portion of the tax, is more important. The case of duties on the produce of land or of mines. These might be so high as to diminish materially the demand for the produce, and compel the abandonment of some of the inferior qualities of land or mines. Supposing this to be the effect, the consumers, both in the country itself and in those which deal with it, would obtain the produce at smaller cost, and a part only, instead of the whole, of the duty would fall on the purchaser, who would be indemnified chiefly at the expense of the landowners or mine owners in the producing country. Duties on importation may then be divided, quote, into two classes. 1. Those which have the effect of encouraging some particular branch of domestic industry, protective duties. 2. And those which have not, revenue duties. The former are purely mischievous, both to the country imposing them and to those with whom it trades. They prevent a saving of labor and capital, which, if permitted to be made, would be divided in some proportion or other between the importing country and the countries which buy what that country does or might export. The other class of duties are those which do not encourage one mode of procuring an article at the expense of another, but allow interchange to take place, just as if the duty did not exist, and to produce the saving of labor which constitutes the motive to international as to all other commerce. Of this kind are duties on the importation of any commodity which could not by any possibility be produced at home, and duties not sufficiently high to counterbalance the difference of expense between the production of the article at home and its importation. Of the money which is brought into the treasury of any country by taxes of this last description, a part only is paid by the people of that country, the remainder by the foreign consumers of their goods. Nevertheless, this latter kind of taxes are in principle as ineligible as the former, though not precisely on the same ground. A protecting duty can never be a cause of gain, but always and necessarily of loss to the country imposing it, just so far as it is efficacious to its end. A non-protecting duty, on the contrary, would in most cases be a source of gain to the country imposing it, insofar as throwing part of the weight of its taxes upon other people is a gain. But it would be a means which it could seldom be advisable to adopt, being so easily counteracted by a precisely similar proceeding on the other side. If the United States, in the case already supposed, sought to obtain for herself more than her natural share of the advantage of the trade with England, by imposing a duty upon iron, England would only have to impose a duty upon corn, sufficient to diminish the demand for that article about as much as the demand for iron had been diminished in the United States by the tax. Things would then be as before, and each country would pay its own tax, unless indeed the sum of the two duties exceeded the entire advantage of the trade, for in that case the trade and its advantage would cease entirely. There would be no advantage, therefore, in imposing duties of this kind, with a view to gain by them in the manner which has been pointed out. But, when any part of the revenue is derived from taxes on commodities, these may often be as little objectionable as the rest. It is evident, too, that considerations of reciprocity, which are quite unessential when the matter in debate is a protecting duty, are of material importance when the repeal of duties of this other description is discussed. A country cannot be expected to renounce the power of taxing foreigners, unless foreigners will in return practice toward itself the same forbearance. The only mode in which a country can save itself from being a loser by the revenue duties imposed by other countries on its commodities is to impose corresponding revenue duties on theirs. Only it must take care that those duties be not so high as to exceed all that remains of the advantage of the trade, and put an end to importation altogether, causing the article to be either produced at home or imported from another and dearer market." End quote. Comment by Professor Laughlin. By reciprocity is meant that, when one country admits goods free of duty from a second country, this latter country will also admit the commodities of the former free of duty, or, as is often the case, if not free of duty, at a less than the usual rate. Until the last few years we have had a reciprocity treaty with Canada, but it is not now in force, and an arrangement for closer commercial relations with Mexico is now under consideration. End of comment. End of Book 5, Chapter 3, Part 2.
Book 5, Chapter 4 of Principles of Political Economy. This is a LibriVox recording. All LibriVox recordings are in the public domain. For more information or to volunteer, please visit LibriVox.org. Principles of Political Economy by John Stuart Mill. Abridged by J. Laurence LAUGHLIN. Section 53. Book 5, Chapter 4. Comparison between Direct and Indirect Taxation. Section 1. Arguments for and against direct taxation. Are direct or indirect taxes the most eligible? A man dislikes not so much the payment as the act of paying. He dislikes seeing the face of the tax collector and being subjected to his peremptory demand. Perhaps, too, the money which he is required to pay directly out of his pocket is the only taxation which he is quite sure that he pays at all. That a tax of 2 shillings per pound on tea, or of 3 shillings per bottle on wine, raises the price of each pound of tea and bottle of wine which he consumes by that and more than that amount, cannot indeed be denied. It is the fact, and is intended to be so, and he himself at times is perfectly aware of it, but it makes hardly any impression on his practical feelings and associations, serving to illustrate the distinction between what is merely known to be true and what is felt to be so. The unpopularity of direct taxation, contrasted with the easy manner in which the public consent to let themselves be fleeced in the prices of commodities, has generated in many friends of improvement a directly opposite mode of thinking to the foregoing. They contend that the very reason which makes direct taxation disagreeable makes it preferable. Under it everyone knows how much he really pays, and if he votes for a war or any other expensive national luxury, he does so with his eyes open to what it costs him. If all taxes were direct, taxation would be much more perceived than at present, and there would be a security, which now there is not, for economy in the public expenditure. Although this argument is not without force, its weight is likely to be constantly diminishing. The real incidence of indirect taxation is every day more generally understood and more familiarly recognized. The mere distinction between paying money directly to the tax collector and contributing the same sum through the intervention of the tea dealer or the wine merchant no longer makes the whole difference between dislike or opposition and passive acquiescence. If our present revenue of $400 million in 1883 were all raised by direct taxes, an extreme dissatisfaction would certainly arise at having to pay so much. But while men's minds are so little guided by reason as such a change of feeling from so irrelevant a cause would imply, so great an aversion to taxation might not be an unqualified good. Of the $400 million in question, nearly $60 million are pledged, under the most binding obligations, to those whose property has been borrowed and spent by the state. And while this debt remains unredeemed, a greatly increased impatience of taxation would involve no little danger of a breach of faith. That part, indeed, of the public expenditure which is devoted to the maintenance of civil and military establishments, $206 million, that is, all except the interest of the national debt, affords in many of its details ample scope for retrenchment. If so great an addition were made to the public dislike of taxation as might be the consequence of confining it to the direct form, the classes who profit by the misapplication of public money might probably succeed in saving that by which they profit, at the expense of that which would only be useful to the public. There is, however, a frequent plea in support of indirect taxation which must be altogether rejected as grounded on a fallacy. We are often told that taxes on commodities are less burdensome than other taxes, because the contributor can escape from them by ceasing to use the taxed commodity. He certainly can, if that be his object, deprive the government of the money, but he does so by a sacrifice of his own indulgences, which, if he chose to undergo it, would equally make up to him for the same amount taken from him by direct taxation. Suppose a tax laid on wine sufficient to add $25 to the price of the quantity of wine which he consumes in a year. He has only, we are told, to diminish his consumption of wine by $25, and he escapes the burden. True, but if the $25 instead of being laid on wine had been taken from him by an income tax, he could, by expending $25 less in wine, equally save the amount of the tax, so that the difference between the two cases is really illusory. If the government takes from the contributor $25 a year, whether in one way or another, exactly that amount must be retrenched from his consumption to leave him as well off as before. And in either way the same amount of sacrifice, neither more nor less, is imposed on him. On the other hand, it is some advantage on the side of indirect taxes that what they exact from the contributor is taken at a time and in a manner likely to be convenient for him. It is paid at a time when he has, at any rate, a payment to make. It causes, therefore, no additional trouble, nor, unless the tax be on necessaries, any inconvenience but what is inseparable from the payment of the amount. He can also, except in the case of very perishable articles, select his own time for laying in a stock of the commodity, and consequently for payment of the tax. The producer or dealer who advances these taxes is indeed sometimes subjected to inconvenience. But in the case of imported goods, this system, under which instead of paying the duty at the time of importation, he is only required to do so when he takes out the goods for consumption, which is seldom done until he has either actually found, or has the prospect of immediately finding, a purchaser. The strongest objection, however, to raising the whole or the greater part of a large revenue by direct taxes is the impossibility of assessing them fairly without a conscientious cooperation on the part of the contributors, not to be hoped for in the present low state of public morality. In the case of an income tax, we have already seen that unless it be found practicable to exempt savings altogether from the tax, the burden cannot be apportioned with any tolerable approach to fairness upon those whose incomes are derived from business or professions. And this is in fact admitted by most of the advocates of direct taxation, who, I am afraid, generally get over the difficulty by leaving those classes untaxed, and confining their projected income tax to realized property, in which form it certainly has the merit of being a very easy form of plunder. But enough has been said in condemnation of this expedient. We have seen, however, that a house tax is a form of direct taxation not liable to the same objections as an income tax, and indeed liable to as few objections of any kind as perhaps any of our indirect taxes. But it would be impossible to raise, by a house tax alone, the greatest part of the revenue without producing a very objectionable overcrowding of the population, through the strong motive which all persons would have to avoid the tax by restricting their house accommodation. A certain amount of revenue may, as we have seen, be obtained without injustice by a peculiar tax on rent. Besides, 1. The land tax, and 2. An equivalent for the revenue derived from the stamp duties on the conveyance of land, some further taxation might, I have contended, at some future period be imposed. 3. To enable the state to participate in the progressive increase of the incomes of landlords from natural causes. 4. Legacies and inheritances, we have also seen, ought to be subjected to taxation sufficient to yield a considerable revenue. With these taxes, and 5. A house tax of suitable amount, we should, I think, have reached the prudent limits of direct taxation. The remainder of the revenue would have to be provided by taxes on consumption, and the question is, which of these are the least objectionable? Section 2. What forms of indirect taxation are most eligible? There are some forms of indirect taxation which must be peremptorily excluded. 1. Taxes on commodities for revenue purposes must not operate as protecting duties, but must be levied impartially on every mode in which the articles can be obtained, whether produced in the country itself or imported. 2. An exclusion must also be put upon all taxes on the necessaries of life, or on the materials or instruments employed in producing those necessaries. Such taxes are always liable to encroach on what should be left untaxed, the incomes barely sufficient for healthful existence. And on the most favorable supposition, namely that wages rise to compensate the laborers for the tax, it operates as a peculiar tax on profits, which is at once unjust and detrimental to national wealth. Footnote. Some argue that the materials and instruments of all production should be exempt from taxation, but these, when they do not enter into the production of necessaries, seem as proper subject of taxation as the finished article. It is chiefly with reference to foreign trade that such taxes have been considered injurious. Internationally speaking, they may be looked upon as export duties, and unless in cases in which an export duty is advisable, they should be accompanied with an equivalent drawback on exportation. But there is no sufficient reason against taxing the materials and instruments used in the production of anything which is itself a fit object of taxation. Mill. End footnote. What remain are taxes on luxuries, and these have some properties which strongly recommend them. In the first place, they can never by any possibility touch those whose whole income is expended on necessaries, while they do reach those by whom what is required for necessaries is expended on indulgences. In the next place, they operate in some cases as a useful, and the only useful, kind of sumptuary law. A great portion of the expense of the higher and middle classes in most countries is not incurred for the sake of the pleasure afforded by the things on which the money is spent, but from regard to opinion, and an idea that certain expenses are expected from them as an appendage of station. And I cannot but think that expenditure of this sort is a most desirable subject of taxation. When a thing is bought not for its use, but for its costliness, cheapness is no recommendation. Section 3. Practical rules for indirect taxation. In order to reduce as much as possible the inconveniences and increase the advantages incident to taxes on commodities, the following are the practical rules which suggest themselves. 1. To raise as large a revenue as conveniently may be from those classes of luxuries which have most connection with vanity and least with positive enjoyment, such as the more costly qualities of all kinds of personal equipment and ornament. But with regard to horses and carriages, as there are many persons to whom, from health or constitution, these are not so much luxuries as necessaries, the tax paid by those who have but one riding horse, or but one carriage, especially of the cheaper descriptions, should be low, while taxation should rise very rapidly with the number of horses and carriages, and with their costliness. 2. Whenever possible, to demand the tax, not from the producer, but directly from the consumer, since when levied on the producer, it raises the price always by more, and often by much more, than the mere amount of the tax. 3. But as the only indirect taxes which yield a large revenue are those which fall on articles of universal or very general consumption, and as it is therefore necessary to have some taxes on real luxuries, that is, on things which afford pleasure in themselves and are valued on that account rather than for their cost, these taxes should, if possible, be so adjusted as to fall with the same proportional weight on small, on moderate, and on large incomes. This is not an easy matter, since the things which are the subjects of the more productive taxes are in proportion more largely consumed by the poorer members of the community than by the rich. Tea, coffee, sugar, tobacco, fermented drinks can hardly be so taxed that the poor shall not bear more than their due share of the burden. Something might be done by making the duty on the superior qualities which are used by the richer consumers much higher in proportion to the value. But in some cases the difficulty of at all adjusting the duty to the value so as to prevent evasion is said, with what truth I know not, to be insuperable, so that it is thought necessary to levy the same fixed amount on all the qualities alike. 4. As far as is consistent with the preceding rules, taxation should rather be concentrated on a few articles than diffused over many, in order that the expenses of collection may be smaller, and that as few employments as possible may be burdensomely and vexatiously interfered with. 5. Among luxuries of general consumption, taxation should by preference attach itself to stimulants, because these, though in themselves as legitimate indulgence as any others, are more liable than most others to be used in excess, so that the check to consumption naturally arising from taxation is on the whole better applied to them than to other things. 6. As far as other considerations permit, taxation should be confined to imported articles, since these can be taxed with a less degree of vexatious interference, and with fewer incidental bad effects, than when a tax is levied on the field or on the workshop. Custom duties are, caeteris paribus, much less objectionable than excise, but they must be laid only on things which either cannot, or at least will not, be produced in the country itself, or else their production there must be prohibited, as in England is the case with tobacco, or subjected to an excise duty of equivalent amount. 7. No tax ought to be kept so high as to furnish a motive to its evasion, too strong to be counteracted by ordinary means of prevention, and especially no commodity should be taxed so highly as to raise up a class of lawless characters, smugglers, illicit distillers, and the like. Comment. The experience of the United States is pregnant with lessons in this direction. During the war we imposed an internal revenue tax on distilled spirits of so large an amount that it not only produced less revenue than a smaller tax would have done, but it created gigantic frauds, public corruption, and infinite devices to escape the payment. The following table will show how the production, as indicated by the tax, fell off when the tax was excessive. It forced evasions by distillers. It has been found by various experiences that with a less rate the revenue is largely increased. Year 1862 to 1863. Revenue $3,200,000. Production indicated by the tax. Gallons 16 million. Amount of tax. July 1862, 20 cents per gallon. January 1865, $2 per gallon. Year 1867 to 1868. Revenue $14,200,000. Production indicated by the tax. Gallons 7 million. Amount of tax. July 1868, 50 cents per gallon. Year 1868 to 1869. Revenue $34,200,000. Production indicated by the tax. Gallons 16 million. Amount of tax. July 1868, 50 cents per gallon. 1869 to 1870. Revenue, $39,200,000. Production indicated by the tax. Gallons, 18 million. The actual amount reached by taxation is very much less than that known to be actually used by from 10 to 15 millions of gallons, or nearly one-half the product. The openness of the frauds can be judged by the fact that proof spirits were openly sold in the market, and even quoted in price currents at from 2 to 15 cents less per gallon than the rate of tax, and the average cost of manufacture. End comment. In what manner the finer articles of manufacture consumed by the rich might most advantageously be taxed, I must leave to be decided by those who have the requisite practical knowledge. The difficulty would be to effect it without an inadmissible degree of interference with production. In countries which, like the United States, import the principal part of the finer manufactures which they consume, there is little difficulty in the matter, and even where nothing is imported but the raw material, that may be taxed, especially the qualities of it which are exclusively employed for the fabrics used by the richer class of consumers. Thus in England a high custom duty on raw silk would be consistent with principle, and it might perhaps be practicable to tax the finer qualities of cotton or linen yarn, whether spun in the country itself or imported. Section 4. Taxation Systems of the United States and Other Countries. Comment. It will now well repay study to examine Chart No. 21, which shows in what manner the United States have raised their revenues, and to consider how far the right rules of taxation have been followed. 1. For means of comparison, I shall give the last annual budget of the United States in order to make clear from what sources the country derives its revenues. Chart 21. United States Budget, year ending June 30th, 1883. In millions and tenths of millions. Receipts. Customs, $214.7 million. Internal revenue, $144.7 million. Direct tax, $100,000. Sale of public lands, $7.9 million. Miscellaneous, $30.8 million. Net ordinary receipts, $398.2 million. Expenditures. War Department, $48.9 million. Navy Department, $15.3 million. Indians, $7.3 million. Pensions, $66 million. Miscellaneous, $68.7 million. Net ordinary expenditures, $206.2 million. Interest on the public debt, $59.2 million. Total, $265.4 million. This leaves a surplus of $132,839,444 above all expenditures. And our problem is now where to reduce taxation. The annual interest charge is lessening with the payment of the public debt, having fallen from its highest figure of $143,781,591 in 1867 to $59,160,131 in 1883. Our national taxation is practically all indirect, that of internal taxation being chiefly levied on tobacco and distilled spirits, and our customs falling on almost all articles which can be imported, materials as well as manufacture. In the United States, direct taxation on real and personal property is very generally levied for state, county, and municipal purposes. In fact, nearly all the perceptible taxation is the property tax, and inasmuch as the state and county tax is very light, the burden is almost always owing to municipal and town expenditures. People do not seem to be aware of the enormous national burden because the taxes are indirect, and only increase the prices of commodities. Other countries, it will be seen, make a greater use of direct taxation than the United States. In fact, the comparison of the ways by which different countries collect their revenues may naturally show us where we may gain by their experience. 2. The English system is especially interesting because after having had an extended scheme of customs duties, they abandoned it and raised their revenue, some on imported articles, it is true, generally on those which could not be produced in England, but by the income tax and other forms. Footnote. The old condition of things was well described by Sidney Smith. We must pay taxes upon every article which enters into the mouth, or covers the back, or is placed under the foot. Taxes upon everything which is pleasant to see, hear, feel, smell, and taste. Taxes upon warmth, light, and locomotion. Taxes upon everything upon earth and the waters under the earth. On everything that comes from abroad or is grown at home. Taxes on raw material. Taxes on every value that is added to it by the industry of man. Taxes on the sauce which pampers man's appetite, and the drug which restores him to health. On the ermine which decorates the judge, and the rope which hangs the criminal. On the brass nails of the coffin, and on the ribbons of the bride. At bed or at board, couchant or levant, we must pay. The beardless youth manages his taxed horse with a taxed bridle on a taxed road. And the dying Englishman, pouring his medicine, which is paid 7%, into a spoon, which is paid 30%, throws himself back upon his chintz bed, which is paid 22%, makes his will, and expires in the arms of the apothecary, who has paid £100 for the privilege of putting him to death. His whole property is then taxed from 2 to 10%, besides the probate. Large fees are demanded for burying him in the chancel. His virtues are handed down to posterity on taxed marble, and he is then gathered to his fathers, to be taxed no more. End footnote. In 1842, Sir Robert Peel found 1,200 articles subject to customs duties. He began 1. By removing all prohibitions. 2. By reducing duties on raw materials to 5% or less. 3. By limiting the rates on partially manufactured goods to 12%. And 4. Those on wholly manufactured goods to 20%. Now customs duties are levied only on beer, cards, chicory, chocolate, cocoa, coffee, dried fruit, plate, spirits, tea, tobacco, and wine. The following budget gives the sources of revenue for Great Britain. Budget of Great Britain, 1883, in millions and tenths of millions. Receipts, customs, $98.4 million. Excise, such as on tobacco and spirits, $134.9 million. Stamps, $58.5 million. Land tax, $5.2 million. House duty, $8.9 million. Income tax, $60.9 million. Post office, $36.5 million. Telegraph, $8.6 million. Crown lands, $2 million. Interest on loans, Suez Canal, etc., $6.1 million. Miscellaneous, $26.4 million. Total, $446.4 million. Expenditures. Interest on national debt, $148.4 million. Army, Navy, etc., $157.1 million. Cost of Revenue Departments, $45.1 million. Public Works, $9.1 million. Public Departments, Salaries, etc., $12.5 million. Law and Justice, $35.7 million. Education, Science, and Art, $22.9 million. Colonial and Consular, $3.4 million. Civil List, $2 million. Pensions, $2 million. Miscellaneous, $6.8 million. Total expenditures, $445 million. From this it will be seen that in the land income and house taxes Great Britain raises by direct taxation about $75 million, and in customs and excise by indirect taxation about $233 million. 3. The following is the system adopted by Germany, Prussia. German budget, 1881 to 1882, in millions and tenths of millions. Receipts. 1. Property income from domains and forests, $11.7 million. From mines and salt works, $2.5 million. From railways, $22.5 million. Miscellaneous, $5 million. Total, $41.7 million. 2. Royal Lottery, $1 million. 3. Bureau of Justice, $12.7 million. Harbors and Bridges, $500,000. Total, $13.2 million. 4. Direct Taxes, $35.5 million. 5. Indirect Taxes for Prussia, $12.3 million. Total receipts, $103.6 million. Expenditures: Civil List, $3 million. Debt, $25 million. Various ministries, schools, etc., $49.5 million. Pensions, $4 million. Miscellaneous, $19.5 million. Total expenditures, $101 million. The Prussian direct taxes include 1. A land tax, 2. A house tax, 3. An income tax, 4. A class tax, 5. A trade tax, and 6. Miscellaneous taxes. 4. How the French supply themselves may be seen by the following statement. French budget 1881 in millions and tenths of millions. Receipts: direct taxes $75.9 million. Similar taxes $4.7 million. Registry, stamps, etc. $135.1 million. Forests $7.6 million. Customs $65.4 million, including salt duty $3.5 million. Indirect taxes, including tobacco, $209.7 million. Post office and telegraph, $27.2 million. Miscellaneous, $29.8 million. Total receipts, $555.4 million. Expenditures, public debt, etc., $249 million. General functions of the ministries, $243.7 million. Administrative expenses, cost of revenue collections, etc., $58.5 million. Miscellaneous, $3.5 million. Total expenditures, $554.7 million. The direct taxes are 1. On property, 2. One nearly like our poll tax together with a species of income tax, 3. A tax on doors and windows, and 4. One on licenses. In comment. Section 5. A resume of the general principles of taxation. After the manner of our classification and resume of the subject of value and money, it may be convenient to here insert a recapitulation of the various principles under the treatment of taxation. Comparison between direct and indirect taxation. Adam Smith's canon of taxation. A tax should be 1. Equal in amount of sacrifice entailed. 2. Certain. 3. Timely. 4. All for the state. A tax is either direct or indirect on commodities. Direct taxes are on income, on expenditure. Taxes on income are general, specific. General income taxes. The best of taxes if people were all honest. As it is, it falls most heavily on the conscientious. Should be reserved for emergency. All savings and a fixed amount in all income should be exempt. Special taxes are on rent, wages, profits. Taxes on rent. Agricultural rent is meant. It falls entirely on the landlord, and if not balanced by taxes on other classes, is unjust. May be blended with a tax on profits if on rent due to landlord's improvements. Taxes on wages are on skilled, on unskilled. Skilled wages are at a monopoly price, and taxes on them are paid by the laborers so long as wages are not reduced below their just proportion. Unskilled wages. 1. Population diminished by it. Paid by profits. 2. Population left stationary. Shared between profits and wages. 3. Population increasing in spite of it. Falls entirely on wages. Taxes on profits. May possible stimulate production, and is then a good all-round contributing to the state, and leaving no one any poorer. If not, if profits are really diminished by the tax, capital may be diminished also. This A may, or B may not diminish population. If A, then the margin of cultivation ceases to be extended, and part of the tax, pro tanto, falls on the landlords. If B, then wages fall, and part of the tax falls on the laborer. Total result is a nearer approach to the stationary state. Taxes on expenditure are open to the same objections as the general income tax. They may be assessed taxes, house tax. Assessed taxes, such as on servants, dogs, etc., these are rigidly direct. House taxes are on building rent, on ground rent. House taxes on building rent are paid by occupier. This tax is indirect. House taxes on ground rent are 1. With, or 2. Without an equivalent tax on agricultural rent. 1. Are paid by ground landlord wholly, and therefore direct. 2. Are paid by occupier, and therefore indirect. Indirect taxes are excise, customs, or tolls. Indirect taxes may be on 1. Long, or 2. Short investments of capital. Indirect taxes on long investments are always unadvisable in view of Canon 4. Indirect taxes on short investments are subject to the laws of indirect taxation. 1. Tax vanities rather than positive enjoyments, e.g., liveries rather than servants. 2. The consumer and not the producer should pay the tax collector, Canon 4, that is, collect the tax as near the actual consumer as possible. 3. Taxes on real enjoyments to be kept as equal as possible for large and small means. 4. Tax as few articles as possible. England taxes only a very small number of imports. The United States taxes nearly everything imported. 5. Tax stimulants freely. The United States collect $91 million from spirits and liquors, and $42 million from tobacco, 1883. 6. Tax imports of commodities not made at home, or whose home production is under an excise, internal revenue duty equal to the customs tax. 7. Keep the rate of tax low in order to get most revenue. End of section 53. Recording by Philip Gould.
Book 5, Chapter 5 of Principles of Political Economy. This is a LibriVox recording. All LibriVox recordings are in the public domain. For more information or to volunteer, please visit LibriVox.org. Recording by Shasta, Oakland, California. Principles of Political Economy by John Stuart Mill. Abridged by J. Laurence LAUGHLIN. Section 54. Chapter 5. Of a National Debt. Section 1. Is it desirable to defray extraordinary public expenses by loans? The question must now be considered how far it is right or expedient to raise money for the purposes of government, not by laying taxes to the amount required, but by taking a portion of the capital of the country in the form of a loan and charging the public revenue with only the interest. This question has already been touched upon in the first book. We remarked that if the capital taken in loans is abstracted from funds, either engaged in production or destined to be employed in it, their diversion from that purpose is equivalent to taking the amount from the wages of the laboring classes. Borrowing, in this case, is not a substitute for raising the supplies within the year. A government which borrows does actually take the amount within the year, and that too by a tax exclusively on the laboring classes, than which it could have done nothing worse if it had supplied its wants by avowed taxation, and in that case the transaction and its evils would have ended with the emergency, while by the circuitous mode adopted, the value exacted from the laborers is gained not by the state, but by the employers of labor, the state remaining charged with the debt besides, and with its interest in perpetuity. The system of public loans in such circumstances may be pronounced the very worst which, in the present state of civilization, is still included in the catalogue of financial expedients. We, however, remarked that there are other circumstances in which loans are not chargeable with these pernicious consequences, namely, first, when what is borrowed is foreign capital, the overflowings of the general accumulation of the world, or, secondly, when it is capital which either would not have been saved at all, unless this mode of investment had been open to it, or, after being saved, would have been wasted in unproductive enterprises, or sent to seek employment in foreign countries. When the progress of accumulation has reduced profits either to the ultimate or to the practical minimum, to the rate less than which would either put a stop to the increase of capital or send the whole of the new accumulations abroad, government may annually intercept these new accumulations without trenching on the employment or wages of the laboring classes in the country itself, or perhaps in any other country. To this extent, therefore, the loan system may be carried without being liable to the utter and peremptory condemnation which is due to it when it overpasses this limit. What is wanted is an index to determine whether in any given series of years, as during the last great war, for example, the limit has been exceeded or not. Such an index exists, at once a certain and obvious one. Did the government, by its loan operations, augment the rate of interest? If it only opened a channel for capital which would not otherwise have been accumulated, or which, if accumulated, would not have been employed within the country, this implies that the capital which the government took and expended could not have found employment at the existing rate of interest. So long as the loans do no more than absorb this surplus, they prevent any tendency to a fall of the rate of interest, but they cannot occasion any rise. But to the full extent to which the loans of government during the war caused the rate of interest to exceed what it was before, and what it has been since, those loans are chargeable with all the evils which have been described. If it be objected that interest only rose because profits rose, I reply that this does not weaken, but strengthens the argument. If the government loans produced the rise of profits by the great amount of capital which they absorbed, by what means can they have had this effect unless by lowering the wages of labor? It will perhaps be said that what kept profits high during the war was not the drafts made on the national capital by the loans, but the rapid progress of industrial improvements. This, in great measure, was the fact, and it, no doubt, alleviated the hardship to the laboring classes, and made the financial system, which was pursued less actively, mischievous, but not less contrary to principle. These very improvements in industry made room for a larger amount of capital, and the government, by draining away a great part of the annual accumulations, did not indeed prevent that capital from existing ultimately, for it started into existence with great rapidity after the peace, but prevented it from existing at the time, and subtracted just so much while the war lasted from distribution among productive laborers. If the government had abstained from taking this capital by loan, and had allowed it to reach the laborers, but had raised the supplies which it required by a direct tax on the laboring classes, it would have produced, in every respect but the expense and inconvenience of collecting the tax, the very same economical effects which it did produce, except we should not have had the debt. The course it actually took was, therefore, worse than the very worst mode which it could possibly have adopted of raising the supplies within the year, and the only excuse or justification which it admits of, so far as that excuse could be truly pleaded, was hard necessity. The impossibility of raising so enormous an annual sum by taxation, without resorting to taxes, which from their odiousness or from the facility of evasion, it would have been found impracticable to enforce. When government loans are limited to the overflowings of the national capital, or to those accumulations which would not take place at all unless suffered to overflow, they are at least not liable to this grave condemnation. In this case, therefore, the question really is what it is commonly supposed to be in all cases, namely, a choice between a great sacrifice at once and a small one indefinitely prolonged. On this matter, it seems rational to think that the prudence of a nation will dictate the same conduct as the prudence of an individual, to submit to as much of the privation immediately as can easily be borne, and only when any further burden would distress or cripple them too much, to provide for the remainder by mortgaging their future income. It is an excellent maxim to make present resources sufficient for present wants. The future will have its own wants to provide for. On the other hand, it may reasonably be taken into consideration that in a country increasing in wealth, the necessary expenses of government do not increase in the same ratio as capital or population. Any burden, therefore, is always less and less felt, and since those extraordinary expenses of government which are fit to be incurred at all are mostly beneficial beyond the existing generation, there is no injustice to make posterity pay a part of the price if the inconvenience would be extreme of defraying the whole of it by the exertions and sacrifices of the generation which first incurred it. Section 2. Not desirable to redeem a national debt by a general contribution. When a country, wisely or unwisely, has burdened itself with a debt, is it expedient to take steps for redeeming that debt? In principle, it is impossible not to maintain the affirmative. Two modes have been contemplated of paying off a national debt, either at once by a general contribution or gradually by a surplus revenue. The first would be incomparably the best, if it were practicable, and it would be practicable if it could justly be done by assessment on property alone. If property bore the whole interest of the debt, property might, with great advantage to itself, pay it off. since this would be merely surrendering to a creditor the principal sum, the whole annual proceeds of which were already his by law, and would be equivalent to what a landowner does when he sells part of his estate to free the remainder from a mortgage. But property, it need hardly be said, does not pay, and cannot justly be required to pay the whole interest of the debt. Whatever is the fitting contribution from property to the general expenses of the state, in the same and in no greater proportion should it contribute toward either the interest or the repayment of the national debt. This, however, if admitted, is fatal to any scheme for the extension of the debt by a general assessment on the community. Persons of property could pay their share of the amount by a sacrifice of property, and have the same net income as before. If those who have no accumulation, but only incomes, were required to make up by a single payment the equivalent of the annual charge laid on them by the taxes maintained to pay the interest of the debt, they could only do so by incurring a private debt equal to their share of the public debt, while, from the insufficiency, in most cases, of the security which they could give, the interest would amount to a much larger annual sum than their share of that now paid by the state. Besides, a collective debt defrayed by taxes has, over the same debt parceled out among individuals, the immense advantage that it is virtually a mutual insurance among the contributors. If the fortune of a contributor diminishes, his taxes diminish. If he is ruined, they cease altogether, and his portion of the debt is wholly transferred to the solvent members of the community. If it were laid on him as a private obligation, he would still be liable to it, even when penniless. When the state possesses property, in land or otherwise, which there are not strong reasons of public utility for its retaining at its disposal, this should be employed as far as it will go in extinguishing debt. Any casual gain or godsend is naturally devoted to the same purpose. Beyond this, the only mode which is both just and feasible of extinguishing or reducing a national debt is by means of a surplus revenue. Section 3. In what cases desirable to maintain a surplus revenue for the redemption of debt? The desirableness per se of maintaining a surplus for this purpose does not, I think, admit of a doubt. It is not, however, advisable in all cases to maintain a surplus revenue for the extinction of debt. The advantage of paying off the national debt is that it would enable us to get rid of the worst half of our taxation. But of this worst half, some portions must be worse than others, and to get rid of those would be a greater benefit proportionally than to get rid of the rest. If renouncing a surplus revenue would enable us to dispense with a tax, we ought to consider the very worst of all our taxes as precisely the one which we are keeping up for the sake of ultimately abolishing taxes not so bad as itself. In a country advancing in wealth, whose increasing revenue gives it the power of ridding itself from time to time of the most inconvenient portions of its taxation, I conceive that the increase of revenue should rather be disposed of by taking off taxes than by liquidating debt, as long as any very objectionable imposts remain. In the present state of England, therefore, I hold it to be good policy in the government, when it has a surplus of an apparently permanent character, to take off taxes, provided these are rightly selected, even when no taxes remain, but such as are not unfit form part of a permanent system. It is wise to continue the same policy by experimental reductions of those taxes, until the point is discovered at which a given amount of revenue can be raised with the smallest pressure on the contributors. After this, such surplus revenue as might arise from any further increase of the produce of the taxes should not, I conceive, be remitted, but applied to the redemption of debt. Eventually, it might be expedient to appropriate the entire produce of particular taxes to this purpose, since there would be more assurance that the liquidation would be persisted in, if the fund destined to it were kept apart and not blended with the general revenues of the state. The succession duties would be peculiarly suited to such a purpose, since taxes paid as they are out of capital would be better employed in reimbursing capital than in defraying current expenditure. If this separate appropriation were made, any surplus afterward arising from the increasing produce of the other taxes and from the saving of interest on the successive portions of debt paid off might form a ground for a remission of taxation. Since the war, the surplus revenue of the United States has been constantly appropriated for the payment of the public debt incurred during the late war, until, what with the reduction of debt and the fall in the interest charge, our income is now so much greater than expenditure that we are, in 1884, actually in difficulties owing to the surplus. To the present time, the Treasury has been able to use its excess of receipts in redeeming matured debt, but the rapidity of the payment has been such that in 2 years or more no matured debt will exist to be redeemed. $250 million of 4.5% bonds remain, but they do not fall due until 1891, and the 4% bonds to the amount of $737,620,700 do not mature until 1907. Having once raised a large revenue under war pressure, it seems very difficult for people to understand now why heavy duties were originally levied, and the extraordinary suggestion is often made that the surplus should remain, and new channels of expenditure should be made, such as enormous pensions, simply in order to keep up the heavy taxation. The difficulty is, however, that the unnecessary surplus exists because of customs duties levied for war purposes, but the heavy burden of war taxation ought not to be continued, adding to the cost of production in all industries, without doing a greater wrong than would be done by the passing, and only possible, trouble of a redistribution of capital in a few cases, especially since that distribution of capital will be one from less productive to more productive industries. Otherwise, no change would be made. End of Book 5, Chapter 5.
Book 5, Chapter 6, Part 1 of Principles of Political Economy. This is a LibriVox recording. All LibriVox recordings are in the public domain. For more information or to volunteer, please visit LibriVox.org. Principles of Political Economy by John Stuart Mill. Abridged by J. Laurence LAUGHLIN. Book 5, Chapter 6 of the Interference of Government Grounded on Erroneous Theories. Part 1. Section 1. The Doctrine of Protection to Native Industry. We proceed to the functions of government which belong to what I have termed, for want of a better designation, the optional class, those which are sometimes assumed by governments and sometimes not, and which is not unanimously admitted that they ought to exercise. We will begin by passing in review false theories, which have from time to time formed the ground of acts of government more or less economically injurious. Of these false theories, the most notable is the doctrine of protection to native industry, a phrase meaning the prohibition or the discouragement by heavy duties of such foreign commodities as are capable of being produced at home. If the theory involved in this system had been correct, the practical conclusions grounded on it would not have been unreasonable. The theory was that to buy things produced at home was a national benefit, and the introduction of foreign commodities generally a national loss. It being at the same time evident that the interest of the consumer is to buy foreign commodities in preference to domestic, whenever they are either cheaper or better. The interest of the consumer appeared in this respect to be contrary to the public interest. He was certain, if left to his own inclinations, to do what according to the theory was injurious to the public. It was shown, however, in our analysis of the effects of international trade, as it had been often shown by former writers, that the importation of foreign commodities in the common course of traffic never takes place except when it is, economically speaking, a national good, by causing the same amount of commodities to be obtained at a smaller cost of labor and capital to the country. To prohibit, therefore, this importation, or impose duties which prevent it, is to render the labor and capital of the country less efficient in production than they would otherwise be, and compel a waste of the difference between the labor and capital necessary for the home production of the commodity and that which is required for producing the things with which it can be purchased from abroad. The amount of national loss thus occasioned is measured by the excess of the price at which the commodity is produced over that at which it could be imported. In the case of manufactured goods, the whole difference between the two prices is absorbed in indemnifying the producers for waste of labor, or of the capital which supports that labor. Those who are supposed to be benefited, namely the makers of the protected articles, unless they form an exclusive company and have a monopoly against their own countrymen as well as against foreigners, do not obtain higher profits than other people. All is sheer loss to the country as well as to the consumer. Of the industries in a country, some are said to need protection and others not. That is, those industries which are carried on at a relative disadvantage are the only ones which need protection in order that they may continue in operation. But relative disadvantage is meant a greater relative cost or sacrifice to the same amount of labor and capital. Those industries which cannot yield so great a value for the labor and capital engaged in them as other more profitable industries are those which are said to need protection. Wherever protective duties exist, it is implied by those who lay them on that there production is carried on under more onerous conditions than in other competing places or occupations. After duties are thus supposed to have protected the less advantageously situated occupations, it may be said that all industries will then have an equal chance. No doubt, as Mr. Cairns says, they would be equalized just as by compelling everyone to move about with a weight attached to his leg. The weight would, indeed, be an impediment to locomotion, but, provided it were in each case exactly proportioned to the strength of the limb which drew it, no one would have any reason to complain. No one would walk as fast as if his limbs were free, but then his neighbor would be equally fettered, and if it took him twice as long to reach his destination as before, he would at least have company on his journey. Section 2 had its origin in the mercantile system. The restrictive and prohibitory policy was originally grounded on what is called the mercantile system, which, representing the advantage of foreign trade to consist solely in bringing money into the country, gave artificial encouragement to exportation of goods and discountenanced their importation. The only exceptions to the system were those required by the system itself. The materials and instruments of production were the subject of a contrary policy, directed, however, to the same end. They were freely imported and not permitted to be exported, in order that manufacturers, being more cheaply supplied with the requisites of manufacture, might be able to sell cheaper and therefore to export more largely. For a similar reason, importation was allowed and even favored when confined to the productions of countries which were supposed to take from the country still more than it took from them, thus enriching it by a favorable balance of trade. As part of the same system, colonies were founded, for the supposed advantage of compelling them to buy our commodities, or at all events not to buy those of any other country, in return for which restriction we were generally willing to come under an equivalent obligation with respect to the staple productions of the colonists. The consequences of the theory were pushed so far that it was not unusual even to give bounties on exportation and induce foreigners to buy from England rather than from other countries by a cheapness which England artificially produced, by paying part of the price for them out of their own taxes. This is a stretch beyond the point yet reached by any private tradesman in his competition for business. No shopkeeper, I should think, ever made a practice of bribing customers by selling goods to them at a permanent loss, making it up to himself from other funds in his possession. The principle of the mercantile theory is now given up even by writers and governments who still cling to the restrictive system. Whatever hold that system has over men's minds, independently of the private interests exposed to real or apprehended loss by its abandonment, is derived from fallacies other than the old notion of the benefits of heaping up money in the country. The most effective of these is the specious plea of employing our own countrymen and our national industry, instead of feeding and supporting the industry of foreigners. The answer to this, from the principles laid down in former chapters, is evident. Without reverting to the fundamental theorem discussed in an early part of the present treatise respecting the nature and sources of employment for labor, it is sufficient to say, what has usually been said by the advocates of free trade, that the alternative is not between employing our own people and foreigners, but between employing one class and another of our own people. The imported commodity is always paid for, directly or indirectly, with the produce of our own industry, that industry being, at the same time, rendered more productive, since with the same labor and outlay we are enabled to possess ourselves of a greater quantity of the article. Those who have not well considered the subject are apt to suppose that our exporting an equivalent in our own produce for the foreign articles we consume depends on contingencies, on the consent of foreign countries to make some corresponding relaxation of their own restrictions. or on the question whether those from whom we buy are induced by that circumstance to buy more from us, and that if these things, or things equivalent to them, do not happen, the payment must be made in money. Now, in the first place, there is nothing more objectionable in a money payment than in payment by any other medium, if the state of the market makes it the most advantageous remittance, and the money itself was first acquired, and would again be replenished by the export of an equivalent value of our own products. But in the next place, a very short interval of paying in money would so lower prices as either to stop a part of the importation or raise up a foreign demand for our produce sufficient to pay for the imports. I grant that this disturbance of the equation of international demand would be in some degree to our disadvantage in the purchase of other imported articles, and that a country which prohibits some foreign commodities does, ceteris paribus, obtain those which it does not prohibit at a less price than it would otherwise have to pay. To express the same thing in other words, a country which destroys or prevents altogether certain branches of foreign trade, thereby annihilating a general gain to the world, which would be shared in some proportion between itself and other countries, does, in some circumstances, draw to itself, at the expense of foreigners, a larger share than would else belong to it, of the gain arising from that portion of its foreign trade which it suffers to subsist. But even this it can only be enabled to do if foreigners do not maintain equivalent prohibitions or restrictions against its commodities. In any case, the justice or expediency of destroying one of two gains in order to engross a rather larger share of the other does not require much discussion. The gain, too, which is destroyed, being in proportion to the magnitude of the transactions, the larger of the two, since it is the one which capital left to itself is supposed to seek by preference. Section 3. Supported by pleas of national subsistence and national defense. Defeated as a general theory, the protectionist doctrine finds support in some particular cases from considerations which, when really in point, involve greater interests than mere saving of labor, the interests of national subsistence and of national defense. The discussions of the Corn Laws have familiarized everybody with the plea that we ought to be independent of foreigners for the food of the people, and the Navigation Laws were grounded in theory and profession on the necessity of keeping up a nursery of seamen for the Navy. On this last subject, I at once admit that the object is worth the sacrifice, and that a country exposed to invasion by sea, if it cannot otherwise have sufficient ships and sailors of its own to secure the means of manning on an emergency an adequate fleet, is quite right in obtaining those means, even at an economical sacrifice in point of cheapness of transport. When the English navigation laws were enacted, the Dutch, from their maritime skill and their low rate of profit at home, were able to carry for other nations, England included, at cheaper rates than those nations could carry for themselves, which placed all other countries at a great comparative disadvantage in obtaining experienced seamen for their ships of war. The navigation laws, by which this deficiency was remedied, and at the same time a blow struck against the maritime power of a nation with which England was then frequently engaged in hostilities, were probably, though economically disadvantageous, politically expedient. But English ships and sailors can now navigate as cheaply as those of any other country, maintaining at least an equal competition with the other maritime nations even in their own trade. The ends which may once have justified navigation laws require them no longer, and afford no reason for maintaining this invidious exception to the general rule of free trade. Since the introduction of steamships and the advance of invention in naval contrivances, The plea for navigation laws on the ground that they keep up a nursery of seamen for the Navy is practically obsolete. The seaman employed on the modern naval ships more nearly resembles the artisan in a manufacturing establishment. He need have but comparatively little knowledge of the sea, since the days of sailing vessels have passed by, so far as naval warfare is concerned. Steam and mechanical appliances now do what was before done by wind and sail. While Mr. Mill thinks navigation laws were economically, that is, so far as increase of wealth is concerned, disadvantageous, yet he believes that they may have been politically expedient. It is possible, for example, that retaliation by the United States and other countries against England early in this century brought about the remission of the English restrictions on foreign shipping. But it is quite another thing to say that such laws produced an ability to sail ships more cheaply. That the English Navigation Acts of 1651 built up English shipping is not supported by many proofs, whereas it is very distinctly shown that English shipping languished and suffered under them. Moreover, under the regime of steam and iron, which drew out England's peculiar advantages in iron and coal, in all its history, English shipping never prospered more than it has since the abolition in 1849 of the navigation laws, events which have taken place since Mr. Mill wrote. The United States is still weighed down by navigation laws adapted to medieval conditions, and the relics of a time when retaliation was the cause of their enactment. So long as wooden vessels did the carrying trade, the natural advantages of the United States gave us a proud position on the ocean. Now, however, when it is a question of cheaper iron, steel, and coal for vessels of iron and steel, we are at a possible disadvantage, and the bulk of navigation laws proposed in these days are intended to draw capital, either by raising prices through duties on ships and materials, or by outright bounties and subsidies from industries in which we have advantages to building ships. And until of late, no distinction has been made between shipbuilding and ship owning or ship sailing. Within the last year, 1884, many burdens on ship sailing have been removed. But even when we are permitted to sail ships on equal terms with foreigners, we cannot yet build them with as small a cost as England, which is proved by the very demand of the builders of iron vessels for the retention of protective duties. And our laws do not as yet allow us to buy ships abroad and sail them under our own flag. With regard to subsistence, the plea of the protectionists have been so often and so triumphantly met that it requires little notice here. That country is the most steadily as well as the most abundantly supplied with food which draws its supplies from the largest surface. It is ridiculous to found a general system of policy on so improbable a danger as that of being at war with all the nations of the world at once, or to suppose that, even if inferior at sea, a whole country could be blockaded like a town, or that the growers of food in other countries would not be as anxious not to lose an advantageous market as we should be not to be deprived of their corn. In countries in which the system of protection is declining, but not yet wholly given up, such as the United States, a doctrine has come into notice which is a sort of compromise between free trade and restriction, namely, that protection for protection's sake is improper, but that there is nothing objectionable in having as much protection as may incidentally result from a tariff framed solely for revenue. Even in England, regret is sometimes expressed that a moderate fixed duty was not preserved on corn, on account of the revenue it would yield. Independently, however, of the general impolicy of taxes on the necessaries of life, this doctrine overlooks the fact that revenue is received only on the quantity imported, but that the tax is paid on the entire quantity consumed. To make the public pay much, that the Treasury may receive a little, is no eligible mode of obtaining a revenue. In the case of manufactured articles, the doctrine involves a palpable inconsistency. The object of the duty as a means of revenue is inconsistent with its affording, even incidentally, any protection. It can only operate as protection insofar as it prevents importation, and to whatever degree it prevents importation, it affords no revenue. Section 4. On the ground of encouraging young industries. Colonial policy. The only case in which on mere principles of political economy protecting duties can be defensible is when they are imposed temporarily, especially in a young and rising nation, in hopes of naturalizing a foreign industry, in itself perfectly suitable to the circumstances of the country. The superiority of one country over another in a branch of production often arises only from having begun it sooner. There may be no inherent advantage on one part, or disadvantage on the other, but only a present superiority of acquired skill and experience. A country which has this skill and experience yet to acquire may in other respects be better adapted to the production than those which were earlier in the field, and besides, it is a junk remark of Mr. Ray that nothing has greater tendency to promote improvements in any branch of production than its trial under a new set of conditions. But it cannot be expected that individuals should at their own risk, or rather to their certain loss, introduce a new manufacture and bear the burden of carrying it on until the producers have been educated up to the level of those with whom the processes are traditional. A protecting duty continued for a reasonable time will sometimes be the least inconvenient mode in which the nation can tax itself for the support of such an experiment. But the protection should be confined to cases in which there is good ground of assurance that the industry which it fosters will after a time be able to dispense with it, nor should the domestic producers ever be allowed to expect that it will be continued to them beyond the time necessary for a fair trial of what they are capable of accomplishing. The great difficulty with this proposal is that it introduces, what is inconsistent with Mr. Mill's general system, the socialistic basis of state help instead of self-help. If industries will never support themselves, then of course it is a misappropriation of the property of its citizens whenever a government takes a slice by taxation from productive industries and gives it to a less productive one to make up its deficiencies. The only possible theory of protection to young industries is that if protected for a season, the industries may soon grow strong and stand alone. Mr. Mill never contemplated anything else. But the difficulty is constantly met with in putting this theory into practice, that the industry, once that it has learned to depend upon the help of the state, never reaches a stage when it is willing to give up the assistance of the duties. Dependence on legislation begets a want of self-reliance and destroys the stimulus to progress and good management. It is said there has never been an instance in the history of the country where the representatives of such industries, who have enjoyed protection for a long series of years, have been willing to submit to a reduction of the tariff or have proposed it. But on the contrary, their demands for still higher and higher duties are insatiable and never intermitted. The question of fact as to whether or not the United States is indebted for its present manufacturing position to protection when our industries were young seems to be capable of answer, and an answer which shows that protection was imposed generally after the industries got a foothold, and that very little assistance was derived from the duties on imports. The following explanation by Mr. Mill of the meaning put upon his argument of protection to young industries by those who have applied it to the United States will be of no slight interest. The passage has been made use of to show the inapplicability of free trade to the United States, and for similar purpose in the Australian colonies, erroneously in my opinion, but certainly with more plausibility than can be the case in the United States, for Australia really is a new country whose capabilities for carrying on manufacture cannot yet be said to have been tested. But the manufacturing parts of the United States, New England and Pennsylvania, are no longer new countries. They have carried on manufactures on a large scale and with the benefit of high protecting duties for at least 2 generations. Their operatives have had full time to acquire the manufacturing skill in which those of England have preceded them. There has been ample experience to prove that the alleged inability of their manufacturers to compete in the American market with those of Great Britain does not arise merely from the more recent date of their establishment, but from the fact that American labor and capital can, in the present circumstances of America, be employed with greater return and greater advantage to the national wealth in the production of other articles. I have never for a moment recommended or countenanced any protecting industry except for the purpose of enabling the protected branch of industry in a very moderate time to become independent of protection. That moderate time in the United States has been exceeded, and if the cotton and iron of America still need protection against those of the other hemisphere, it is in my eyes a complete proof that they ought not to have it, and that the longer it is continued, the greater the injustice and the waste of national resources will be. There is only one part of the protectionist scheme which requires any further notice: its policy toward colonies and foreign dependencies, that of compelling them to trade exclusively with the dominant country, a country which thus secures to itself an extra foreign demand for its commodities, undoubtedly gives itself some advantage in the distribution of the general gains of the commercial world. Since, however, it causes the industry and capital of the colony to be diverted from channels which are proved to be the most productive, inasmuch as they are those into which industry and capital spontaneously tend to flow, there is a loss, on the whole, to the productive powers of the world, and the mother country does not gain so much as she makes the colony lose. If, therefore, the mother country refuses to acknowledge any reciprocity of obligations, she imposes a tribute on the colony in an indirect mode greatly more oppressive and injurious than the direct. End of Book 5, Chapter 6, Part 1. Book 5, Chapter 6, Part 2 of Principles of Political Economy. This is a LibriVox recording. All LibriVox recordings are in the public domain. For more information or to volunteer, please visit LibriVox.org. Principles of Political Economy by John Stuart Mill. Abridged by J. Laurence LAUGHLIN. Book 5, Chapter 6 of the Interference of Government Grounded on Erroneous Theories. Part 2. Section 5. On the Ground of High Wages. The discussion by Mr. Cairns on the question of wages, as affected by the tariff, is such that I have quoted it as fully as possible. The position taken in the United States is that protection is only needed and only asked for where American industry is placed under a disadvantage as compared with the industry of foreign countries. The rates of wages measured in money are higher in the United States than in Europe, and therefore, it is argued, the cost of producing commodities is higher. The high rates of wages in the United States are not peculiar to any branch of industry, but are universal throughout its whole range. If, therefore, a high rate of wages proves a high cost of production, and a high cost of production proves a need of protection, it follows that the farmers of Illinois and the cotton planters of the southern states stand in as much need of fostering legislation as the cotton spinners of New England or the iron masters of Pennsylvania. A criterion which leads to such results must, I think, be regarded as sufficiently condemned. The fallacy is in truth that all industries are not in each country equally favored or disfavored by nature. and have not, therefore, equal need of this protecting care. If American protectionists are not prepared to demand protective duties in favor of the Illinois farmer against the competition of his English rival, they are bound to admit either that a high cost of production is not incompatible with effective competition, or else that a high rate of wages does not prove a high cost of production. And if this is not so in Illinois, then I wish to know why the case should be different in Pennsylvania or in New England. If a high rate of wages in the first of these states be consistent with a low cost of production, why may not a high rate of wages in Pennsylvania be consistent with a low cost of producing coal and iron? The rate of wages, whether measured in money or in the real remuneration of the laborer, affords an approximate criterion of the cost of production, either of money or of the commodities that enter into the laborer's real remuneration, but in a sense the inverse of that in which it is understood in the argument under consideration. In other words, a high rate of wages indicates not a high, but a low cost of production. Thus, in the United States, the rate of wages is high, whether measured in gold or in the most important articles of the laborer's consumption, a fact which proves that the cost of producing gold, as well as that of producing those other commodities, is low in the United States. I would ask objectors to consider what are the true causes of the high remuneration of American industry. It will surely be admitted that in the last resort, these resolve themselves into the one great fact of its high productive power. I must therefore contend that the high scale of industrial remuneration in America, instead of being evidence of a high cost of production in that country, is distinctly evidence of a low cost of production. Of a low cost of production, that is to say, in the first place, of gold, and in the next, of the commodities which mainly constitute the real wages of labor, a description which embraces at once the most important raw materials of industry and the most important articles of general consumption. As regards commodities not included in this description, the criterion of wages stands in no constant relation of any kind to their cost, and is therefore simply irrelevant to the point at issue. And now we may see what this claim for protection to American industry, founded on the high scale of American remuneration, really comes to. It is a demand for special legislative aid in consideration of the possession of special industrial facilities, a complaint, in short, against the exceptional bounty of nature. Perhaps I shall here be asked, how, if the case be so, if the high rate of industrial remuneration in America be only evidence of a low cost of production, the fact is to be explained, since fact it undoubtedly is, that the people of the United States are unable to compete in neutral markets in the sale of certain important wares with England and other European countries. No one will say that the people of New England, New York, and Pennsylvania are deficient in any industrial qualities possessed by the workmen of any country in the world. How happens it, then, that enjoying industrial advantages superior to other countries, they are yet unable to hold their own against them in the general markets of commerce? I shall endeavor to meet this objection fairly, and in the first place let me state what my contention is with regard to the cost of production in America. I do not contend that it is low in the case of all commodities capable of being produced in the country, but only that of a large, very important, but still limited group. With regard to commodities lying outside this group, I hold that the rate of wages is simply no evidence as to the cost of their production, one way or the other. But secondly, I beg the reader to consider what is meant by the alleged inability of New England and Pennsylvania to compete, let us say, with Manchester and Sheffield in the manufacture of calico and cutlery. What it means, and what it only can mean, is that they are unable to do so consistently with obtaining that rate of remuneration on their industry which is current in the United States. If only American laborers and capitalists would be content with the wages and profits current in Great Britain, there is nothing that I know of to prevent them from holding their own in any markets to which Manchester and Sheffield can send their wares. And this brings us to the heart of the question. Over a large portion of the great field of industry, the people of the United States enjoy, as compared with those of Europe, 1. Advantages of very exceptional kind over the rest. 2. The advantage is less decided. Or 3. They stand on a par with the Europeans. Or 4. Possibly they are, in some instances, at a disadvantage. Engaging in the branches of industry in which their advantage over Europe is great, they reap industrial returns proportionally great. And so long as they confine themselves to these occupations, they can compete in neutral markets against all the world, and still secure the high rewards accruing from their exceptionally rich resources. But the people of the Union decline to confine themselves within these liberal bounds. They would cover the whole domain of industrial activity and think it hard that they should not reap the same rich harvests from every part of the field. They must descend into the arena with Sheffield and Manchester, and yet secure the rewards of Chicago and St. Louis. They must employ European conditions of production and obtain American results. What is this but to quarrel with the laws of nature? These laws have assigned to an extensive range of industries carried on in the United States a high scale of return, far in excess of what Europe can command, to a few others a return on a scale not exceeding the European proportion. American enterprise would engage in all departments alike and obtain upon all the high rewards which nature has assigned only to some. Here we find the real meaning of the inability of Americans to compete with the pauper labor of Europe. They cannot do so, and at the same time secure the American rate of return on their work. The inability no doubt exists, but it is one created not by the drawbacks, but by the exceptional advantages of their position. It is as if a skilled artisan should complain that he could not compete with the hedger and ditcher. Let him only be content with the hedger and ditcher's rate of pay, and there will be nothing to prevent him from entering the lists even against this rival. It is often said that wages are kept at a high rate in the United States by the existence of protected industries. On the other hand, the truth is that the protected industries must pay the current high rate of wages fixed by the general productiveness of all industries in the country. When the facts are investigated, it is surprising how small a portion of the laborers of the United States are employed in occupations which owe their existence to the tariff. A general view of the relative numbers engaged in different occupations may be seen by reference to chart number 24, based on the returns for the census of 1880. The data are well worth examination. Illustration of chart 24, showing for the United States in 1880 the ratio between the total population over 10 years of age and the number of persons reported as engaged in each principal class of gainful occupations, compiled for the returns of the 10th census by the editor. Number of persons engaged in agriculture, 7,670,493. Number of persons engaged in manufacturing, mechanical, and mining, 3,837,112. Number of persons engaged in trade and transportation, 1,810,256. Number of persons engaged in professional and personal services, 4,074,238. Total of all persons in all occupations, 17,392,099. Persons not so engaged, 19,369,508. Total population over 10 years of age, 36,761,607. Of the second class, less than 450,000 work people are engaged in the chief protected industries, cotton, woolen, and iron and steel combined. This class, it is to be noted in the census returns, includes bakers, blacksmiths, brickmakers, builders, butchers, cabinet makers, carpenters, carriage makers, and so on through the whole list of similar occupations practically unaffected by the tariff, so far as protection to them is concerned. So that at most there are less than 1 million laborers engaged in industries directly dependent on the tariff, and the number is undoubtedly very much less than 1 million. When some writers assert, therefore, that the existence of customs duties allows industries, even including all those employed in producing cotton, wool, iron, and steel, to employ less than 1 million laborers in such a way that the remuneration is fixed for the remaining 16 million laborers in the United States, keeping wages high for 16 million by paying current wages for less than 1 million. The extravagance and ignorance of the statement are at once apparent, while on the other hand it is distinctly seen that the causes fixing the generally high rates of wages for the 16 million are those governing the majority of the occupations, and that the less than 1 million must be paid the wages which can be obtained elsewhere in the more productive industries. The facts thus strikingly bear out the principles as stated above. Confirmation. If confirmation now seems necessary, may be found in a study by our ablest statistician Francis A. Walker upon the causes which have operated on the growth of American manufacturers. This growth has not been commensurate, he finds, with the remarkable inventive and industrial capacity of our people, and with the richness of our national resources. Quote, I answer that the cause of that comparative failure is found primarily and principally in the extraordinary success of our agriculture, as already intimated in what has been said of the investment of capital, the enormous profits of cultivating a virgin soil without the need of artificial fertilization, the advantages which a sparse population derives from the privilege of selecting for tillage only the choicest spots, those most accessible, most fertile, most easily brought under the plow, and the consequent abundance of food and other necessaries enjoyed by the agricultural class have tended continually to disparage mechanical industries in the eyes alike of the capitalist, looking to the most remunerative investment of his savings, and of the laborer, seeking that avocation which should promise the most liberal and constant support. It has been the competition of the farm with the shop, which throughout the entire century of our national independence has most effectually hindered the growth of manufactures. A people who are privileged to cultivate a reasonably fertile soil under the conditions indicated above can secure for themselves subsistence up to the highest limit of physical well-being. If that people possess the added advantage of great skill in the use of tools and great adroitness in meeting the large and the little exigencies of the occupation and cultivation of the soil, the fruits of their labor will include not only everything which is essential to health and comfort, but much that is of the nature of luxury." Unquote. It remains to be said in this connection that workmen are already discerning the practical and real causes at work affecting their wages, affecting them more directly than any tariff system possibly could, by showing no small alarm at the immigration of foreigners, such as the Hungarian miners and Italian laborers who willingly underbid them. In other words, they are beginning to realize in a practical way the truth that increasing numbers are far more potent than anything else in reducing wages. So long as immigration is free to any race or nationality, there is no such thing as protection to home laborers. The only protection to them, not that I am urging the desirability of such measures can solely come from forces which limit the number of workmen who enter into competition with them. Any other protection to laboring men than the prohibition of immigration, which no one thinks of, except for the Chinese, is an economic delusion. Instead of protecting them to the extent of affording higher wages, the tariff increases the cost of woolen clothing and other articles of their consumption, in addition to forcing capital into employments which yield a less return, and so ensure lower wages. Section 6. On the ground of creating a diversity of industries. It must be kept in mind that political economy deals only with the phenomena of material wealth. It does not supply ethical or political grounds of action. It is quite conceivable that a legislator, in coming to a decision, may have to balance economic gains against moral or political losses, and may choose to give up the former to prevent the latter. But the economic truth remains unchanged. Political economy, for instance, to the question, is there any gain in international trade, answers unequivocally yes. Would it be a loss of wealth to the community to have the goods formerly bought abroad now produced at home? The answer is certainly it would. But here it has been ably argued by intelligent writers that a state has other ends to gain than the accumulation of mere riches, that it must aim to secure the greatest moral, social, and elevating influences possible for the working classes, and that while free exchange of goods may add to wealth, it may injure the social and political well-being of a nation. So far as these are social and political questions, they do not belong to political economy. But the commonest form of argument is that under free exchange, the United States would become purely an agricultural country. Its social horizon would become narrowed, and a lower standard of industrial activity would then ensue. Instead of which, it is said we should, by protection, keep in existence diversified industries by which the national mind may be better stimulated, and greater enterprise may be encouraged in all branches of industry. This argument for diversity of industries, however, is not merely a sociological question. It can only be fully discussed from an economic standpoint, and deserves even more than the brief attention we give it here. In the first place, as soon as any purely agricultural country gains even a slight density of population, a density only such as to warrant the introduction of the principle of division of labor, there comes an inevitable differentiation of pursuits, wholly outside of legislation and through the operation of natural causes. Not all of any population is required in agriculture to provide the whole with food. By a division of labor, one man in agriculture can produce the sustenance of himself and many others. The United States have at the present time but 5 persons engaged in agriculture for each square mile of settled area. By the side of the farm must early spring up a wide circle of industries: the shoemaker, the carpenter, the blacksmith, the wagon maker, the painter, the builder, the mason, and all the ordinary employments which arise in any small community from the earliest division of labor. Moreover, agriculture is often used in a too limited sense, as confined to producing food alone, although even in that limited sense employing nearly 1/2 of the total number of our laborers. In a new country, the natural field of employment is found in the extractive industries, which include the preparation for the market not only of food, but also of all ores, coal, minerals, oils, hides, leather, wool, lumber, and the industries intimately connected with them. All the employments which transport these from one part of the country to another, employing at present over 1/9 of all our laborers, and professional and personal services of an extended variety. Even, therefore, if we were obliged to forego manufactures entirely, the extractive industries would necessarily involve a very extensive diversity of employments. The real question, however, for most persons, centers in the next stage of the industrial evolution, that of the manufacturers of these above-mentioned products of the extractive industries. It will be remembered here that a country does not possess an equal ability in producing each of these or any commodities. The timber formerly near great rivers may vanish into the interior. The oil sources may be more or less fertile, or the ore deposits may be more or less rich, more or less accessible than those of other countries. This being understood, then, as soon as the demand in the country calls for an increased quantity of a particular article, the cost may increase under the law of diminishing returns until a foreign country, having inferior agents of production as compared with our best, may be able to send supplies into our markets. It all depends on whether the United States wants more articles than can be produced, on grades of natural agents superior to those possessed by foreigners, taking cost of carriage to this country into consideration. Even though foreign competition appears when we reach poorer grades of natural agents, it does not follow that some of the particular articles will not be produced. What ought to be clear is that untrammeled exchange between countries will not prevent the existence of various industries, but only limit production to those grades of agents which are its best. This may be better seen by a simple diagram. England may have 7 different grades of productiveness in her iron and coal supplies, of which her grades 1, 2, and 3 are superior to the best grade of the United States, while grades 1, 2, 3, and 4 in the United States may compare only with grades 4, 5, 6, 7 of England. So long as England can supply herself and the United States also with coal and iron from the 3 superior grades, the United States cannot work grade 1 at home. But if the supply for England and the world requires grade 5 to be worked, then the United States can begin the industry on her best grade, although that is far inferior to the best grade in England. Likewise, if the United States has 3 grades of wheat land superior to England's best grade, the ability of England to grow wheat depends upon whether the United States can or cannot supply both herself and England from grades 1, 2, and 3. If we must resort to grade 4, then England can begin to grow wheat as well as we. In short, under a system of free exchange, as great a diversity as under protection is probably possible, but only in such a way that the best possible advantages in each particular industry are employed. Smaller amounts in some branches and greater amounts in others may be produced under a free than under a restrictive system, but with all the greater gain which arises from a proper and healthy adjustment of trade. The most poorly endowed enterprises in each occupation would be given up, but not the whole industry itself. No class of persons feel the competition of rivals more than English farmers, since American wheat has come into English markets, and yet it does not follow that England cannot grow a bushel of wheat. The fact is merely that some kinds of lands were thrown out of cultivation, and a readjustment made, to the benefit of those wanting cheaper food. So with us, we should not, by the free exchange, be forced to give up the iron and coal industries entirely, for the best minds would still keep that occupation in existence to diversify the others. So far, the explanation covers the extractive industries only, or those industries affected by the law of diminishing returns when a larger quantity is demanded. The real question arises as to the manufactures of these materials, but we count upon larger industrial rewards, in the form of wages and profits, here than in England. We must get more from an industry than England in order to satisfy us. Our grades of occupations, therefore, must be more productive to a certain extent, grade for grade, than English grades, in order to allow of their remaining free from competition. But we have this superiority as regards our home market, owing to natural causes. 1. Cheap raw materials, if we except wool and other commodities whose price is raised by the tariff. 2. Advantage over England in cost of transportation of raw products. And 3. In the cost of transportation again of the finished goods in reaching our markets. Now the processes of manufacture, which do not put much labor upon the materials, especially where the articles are bulky, are conducted in this country without fear of foreign competition. And the range of this class of manufacturers is surprisingly large. It includes the manufacturers of iron, such as stoves and the common utensils of everyday life, of hides, such as leather, harness, etc., and of wood, such as all the furniture of common use. The list is too long to be fully stated here. These industries are not kept in existence by the tariff, and a diversity as wide as this would arise under a system of free exchange, as well as of restriction. Indeed, if duties were removed from so-called raw materials, it is altogether probable that a wider diversity would exist than ever before. And yet, it will be said, there are some things we cannot produce in free competition with England. Of course there are, and it is to be hoped it will long continue so. If there are not some kinds of commodities which foreigners can produce to better advantage than we, then there will be no possibility of any foreign trade whatever. Since, if they can send us nothing, they can take nothing from us. To deny this position is to say that the export and import trade of the United States, amounting in 1883 to more than $1,500,000,000, is of no profit, and had best be entirely destroyed, in order that a few industries, in which we have no natural advantages, and which employ less than 1/17 of the laborers in the United States, should be continued at a loss to the general productiveness of our labor and capital, and so to a general diminution of wages and profits. Section 7. On the ground that it lowers prices. The argument, heard less frequently now than formerly, has been advanced, drawn inductively from statistics, that protection does not raise prices, because after duties are put on, a larger quantity is produced, the advantages of large production are reaped, and then the prices of the manufactured commodity falls lower here than it was before the duty was imposed. The position is then held that protection does not raise prices. It is, of course, understood to mean the prices of protected commodities, a necessary precaution, because we find our own agricultural, unprotected commodities cited to show that prices are lower here than in England. No one, however, will deny that there has been a fall in the prices of textile fabrics and manufactured goods. That is the result of a general law of value, and of the tendencies of a progressive state of industry. The causes of this acknowledged fall would be at work, no matter whether tariffs existed or not. It is the result of the general forward march of improvements, as evidenced in the application of new inventions and the display of skill and ingenuity in new processes. To say that it comes because of a tariff is a complete non sequitur. How true this is may be seen by observing that a country like England, without tariffs, shares in the general fall of prices of manufactured goods equally with the country which has heavy customs duties. The causes must be wider than tariffs, if they are seen working alike in tariff and non-tariff countries. But the fact itself cannot be gainsaid that protection does not raise the prices of the protected goods in the home market. The comparison is not to be made between prices as they now are in this country, and as they were 20 or 40 years ago, also in this country, for this would show only the general march of improvements in this country. But a comparison is to be made between prices in this country today and the present prices in foreign countries. Does, for instance, the tariff increase the price of woolen goods and clothing to every consumer far beyond what the price would be if the duty on imported woolens were removed? The very existence of a protecting duty is the answer to this. If the duty does not raise the price, then why does the woolen industry wish a continuance of the duties? If goods can be sold as cheaply here as the foreign goods, why do protectionists want any duties? The duties are intended to keep foreign goods out of our markets, and they would be unnecessary if our goods could be sold as cheaply as the foreign wares. The facts, however, are at hand to show that the statement of principle as made above is corroborated by the statistics. In 1883, although average weekly wages in Massachusetts were over 77% higher than in England, the American laborer had to pay more for the articles entering into his real wages, and to that extent lost the advantage of his higher reward in this country. This is to be seen in the following figures, which show in percentages whether prices are higher or lower here than in England. The chart shows classes of articles of groceries with a higher percent of 16, provisions including meat, eggs, butter, and potatoes with a lower percent of 23, dry goods, all grades, with a higher percent of 13, boots, shoes, and slippers with a higher percent of 62, and clothing with a higher percent of 45. And yet, in spite of the high prices, 31% of the Massachusetts workman's expenditure represent more comfort and better home surroundings than is enjoyed by the English workman. If the American could purchase at English prices, he would have no less than 37% of a surplus for additional enjoyments, after making due allowance for the higher rents paid here than in England. In other words, higher prices cut off the American laborer from reaping all the superiority and comfort which might be expected from knowing that he had an advantage over the English laborer of 77% in the money wages received. In order that the reader may easily find the arguments of the protectionists, he is referred to the following books. Carey's Principles of Social Science, 3 volumes. The form of argument is briefly that all industries should be kept going within the bounds of a country so as to avoid foreign trade. The change of form into the finished commodity should, he holds, take place near the spot where the raw materials are produced, so that not so great a share should go to the mere middleman or transporters. Bowen's Political Economy, Chapter 20, advocates protection on the ground that it is needed to secure diversity of industries and that it lowers the prices of imported goods. Sir J.B. Byles' Sophisms of Free Trade is an answer to Bastiat's Sophisms of Protection, the latter having been translated into English by Horace White. Erastus B. Bigelow, The Tariff Question. This is one of the ablest discussions from the protectionist point of view, based on statistical tables and comparisons of the policy of England and the United States. Stebbins' Protectionist's Manual is a brief and handy statement. Ellis H. Roberts' Government Revenue is the form into which he has thrown his lectures at Cornell University, 1884, on protection, and is the latest statement emanating from that side of the discussion. He goes at length into the history of taxes in various countries, holds that wages are higher here than in England because of protection, that our manufacturers are more flourishing than our agriculture, etc. Frederick List's National Economy is the German statement of protection, much on Carey's own grounds. The Congressional Globe contains numerous speeches of members of Congress on the tariff, and the Iron and Steel Association of Philadelphia sent out pamphlets explaining the protectionist position. The free trade arguments may be found also in W. M. Grosvenor's Does Protection Protect? He studies the results of the various tariffs of the United States and gives many very valuable tables and collections of statistics bearing upon this question. W.G. Sumner's History of Protection in the United States is a very vigorous account of the evils of the various tariffs and the protective system. D.A. Wells' reports, as Special Commissioner of the Revenue, and his numerous pamphlets, see Putnam's Publishers Catalog, are full of facts and give the results of special study of the subject as affecting the United States. A. L. Perry's Political Economy gives a radical free trade view. Henry Fawcett's Free Trade and Protection explains the causes which have retarded the more general adoption of free trade. J. E. Cairns' Leading Principles of Political Economy gives the ablest discussion of the economic principles involved in the question which has yet been offered to the reader. Moreover, almost all our systematic writers on the political economy, excepting perhaps Bowen and R.E. Thompson, give the system of free exchange their support on economic grounds. End of Book 5, Chapter 6, Part 2. End of Principles of Political Economy by John Stuart Mill, abridged by J. Laurence Laughlin.